partnership and diplomacy gets done.
We've been always there for the U.S. It's not something that we've been doing to buy an influence, but this is a duty on us as a partner.
It's going to take growth in Qatar. It's going to take growth in the United States, the two biggest suppliers in the world, to satisfy the enormous amount of energy growth that's coming.
The GC countries and the economies are bright spots or jewels in the global economy today because of the ability to plan long term.
Do you think there is a chance of Iran also being brought back into the fold?
That's probably a bit over-optimistic, but there's a chance that there could be a nuclear deal that doesn't have some of the shortcomings of the previous nuclear deal.
Unless we have data about the tariffs and the impact of tariffs in the prices, central banks cannot move forward.
These are unprecedented times for those of you who are new into the marketplace, and it's not normal that you have volumes surge to double or triple the levels that they are trading on average. But those are providing opportunities once the markets resettle.
We're revising very deeply how much we should have in fixed income as a conservative asset class. And we're thinking very deep also some of the traditional asset classes that we have, whether we need to increase or decrease.
Well, right now we think investment-grade bonds aren't really good risk. I think U.S. Treasuries, long-dated U.S. Treasuries are interesting.
You have to help your clients to diversify their risks. And with volatility, you can actually grab a really good rate or a really good exchange rate to help. And look at new supply chains.
Now people are driving around with stickers in their cars saying, I bought this before we knew Elon was crazy.
And there are also people who are buying it because Elon's crazy, or however they may view it. So yes, we've lost some sales perhaps on the left, but we've gained them on the right.
And did it make you regret any of, or think twice about your political endeavors?
I did what needed to be done.
Please welcome to the stage Bloomberg's Jumana Bersetchi.
Good morning, everybody. Sabah al-khair. Welcome back.
Good morning.
Of the 5th Qatar Economic Forum. Well, yesterday we were honored to open the forum with His Excellency, the Prime Minister and Minister of Foreign Affairs of the State of Qatar, along with other thought-provoking contributions from some of the world's most influential voices, ending the day, of course, with Elon Musk. Now, today's program continues that momentum with discussions on energy, security, capital investment, digital assets, the business of sports, and much, much more. But before we begin, just a few important announcements. We would like to express our sincere thanks to our partners and our sponsors, our official partners, the Qatar Ministry of Commerce and Industry, Qatar Media City, our culture sponsor, Qatar Museums, our innovation sponsor, Qatar Research Development and Innovation Council, our premier sponsors, Qatar Investment Authority, Qatar National Bank, our knowledge sponsor, McKinsey & Company, our participating sponsors, IDA, HSBC, Investment Promotion Agency Qatar, Qatar Financial Center, Qatar Free Zones Authority, Qatar University, our airline sponsor, Qatar Airways, our connectivity sponsor, Ooredoo, and our tourism sponsor, Visit Qatar. Now, to stay connected, the Wi-Fi network is QEF 2025, and we encourage you to download the Forum app to network and access the full agenda. We'd also love to hear from you throughout the day, so to ask questions to our speakers or to take part in live audience polls, scan the polling and Q&A QR codes behind me over there. And of course, you can continue the conversation online by using the hashtag Qatar Economic Forum. Okay, with that, let's get started. We begin with the Global Investor Outlook.
Please welcome to the stage His Excellency Sheikh Saud Salem Abdulaziz Al Sabah, Managing Director of the Kuwait Investment Authority, and Howard Marks, Co-Chairman of Oaktree Capital Management, for a conversation with Bloomberg's Stephanie Flanders.
Well, we are very grateful to have two enormously distinguished investors sitting in distinctive positions in the market, but I think just from talking earlier, share some of the same investing philosophy. We don't have very much time. I know there's great interest in how you approach investing in this environment, extreme short-term volatility, lots of noise, but also some structural long-term forces, not least the trends that are pushing up the cost of money relative to the last few decades. I want to talk about how you're approaching investing with your distinctive portfolios and approaches, but I know there's also great appetite for getting to where that exactly is leading you on some of the practical opportunities you see, so I hope we're going to have time for both. But Sheikh Saud, you have quite recently become managing director of the oldest sovereign wealth fund, the KIA. Tell me something about how you think about portfolio construction in this environment.
Thank you very much, Stephanie, and it's great to be here today in Doha. And you said something about starting with noise. I would start off by saying, ignore the noise. If you're a long-term investor, ignore the noise. And how we look about global opportunities, we're going to talk about today about identifying opportunities based on mismanagement of risk. And as a long-term investor, you can't be lucky. In order to be successful, you just can't be lucky. Someone can be lucky in the short term, but over the long run, you can't afford to be lucky. And to successfully identify opportunities, you need 4 key things. You need to have a long-term strategy. You need to put a process around it. You need to surround yourself with the talent to pick the right opportunities. And you need to have the guts to make bold decisions when opportunities arise. And as a long-term investor going into portfolio construction, whether you're a sovereign wealth fund or a pension fund, you need to know where you're going, reverse engineer it, and you'll have a return of capital on average that you need to achieve. But that's where the main problem is, because investors sometimes tend to focus on chasing returns, but not looking at risk. So you have to assign a specific risk profile to your investment. And the perception is the more risk you take, the more likelihood of a greater return. But that can be deceiving. You can't avoid risk when investing. You need to understand it and know how to manage it. And risk can be deceiving because it's always an absolute number. It's always positive. But the more risk you take, the more the likelihood of a greater return. But the flip side is also true. The more risk you take, the more the likelihood of a lower return. And that's why you need to put a process around it. Because investing is rational, investors are not. And you need to eliminate emotions when investing, and we've seen that in the 6 months of this year. You've seen very volatile markets. You've seen animal spirits come at the beginning of the year, but they went into hibernation. And we've seen it change. And you'd think the world is upside down, but it probably isn't, and probably Howard has to say a few things about that.
Howard Marks.
Well, you know, this panel's kind of rigged because we agree so much. But, you know, the essence of investing is appropriately bearing risk for profit. If there's no uncertainty, you're not going to get paid very much. And as Sheikh Saud says, you want to have the right mix for your risk tolerance, but you also want to be aware in a long-term sense of where risk is being mispriced, and thus where you can get superior risk-adjusted returns without actually taking too much risk. And, you know, the last 15 years have been a very rosy period. Basically, I would say in the last 15 years, the person who took the most risk made the most money. But by definition, that can't be true all the time, or it wouldn't be risk. And yet, when people go through a very hospitable period and risk-taking is rewarded, it builds up. It's self-reinforcing. Just at the time when you should be reducing it, most people are putting on more. So I think risk consciousness and knowing what's right for you and your institution, not merely return maximization.
I think a lot of people would listen to this and say, that's all very well, but it's assuming you can distinguish these things. So Sheikh Saud talked about ignore the noise, but you don't want to ignore the signal, and you somehow have to tell the difference between the noise and the signal. You've talked about risk and uncertainty, but certainly as economist, I consider there's quite a big difference between the two. Risk is calculable, uncertainty is not calculable. It's just a sheer amount of volatility. So for those of us who haven't got a infallible way of telling the difference between these things, how are you confident that you're ignoring noise and not important signals?
I think you need to focus on hard data and not soft data. So I think if you turn off the TV, and I don't mean turn off Bloomberg, but and look at the hard data coming out of the US, the hard data has been coming in very strongly. But investors have been reacting as if it's the end of the world. So what happened in the past month, I think, is quite significant. You went from a bear market to a bull market in 4 weeks. And that's not normal. And that type of behavior meant people were, because fear of missing out is real. That's the emotional part. So people have been buying into a rising market, then selling when things went south. And that means you bought high and you sold low, and you won't be in business investing, buying high and selling low. So, but in terms of signals, I would say it depends on the price that you're compensated on the uncertainty that's there. I think at the beginning of the year, we know there was a new president coming in. We knew about his policy about tariffs, so we knew about a known unknown, so we knew about tariffs. We didn't know what was the impact, so we knew about a known unknown, but we decided to do nothing about it. And I think that's when complacency came in, and some investors paid the price for it.
Howard, how do you distinguish these? I mean, when you say, you particularly emphasize the importance of understanding risk. But are there times when you say, okay, this isn't actually calculable, I don't know what the risk of this investment is?
Well, first of all, we never know the future. And that's where the risk comes in. There was a professor at the London Business School named Elroy Dimson who said, risk means more things can happen than will happen. And it is from the multiplicity of possibilities that the risk comes in. We have to acknowledge that. And, one of my heroes, John Kenneth Galbraith, said that there are two kinds of forecasters, the ones who don't know and the ones who don't know they don't know. And I think it's very important to know which school you're in. But it's our job to deal with uncertainty. We can't run from it. If risk avoidance ends up in return avoidance. We have to knowingly, intelligently take risk for profit. But the definition of the risk we should take is one that we're aware of, that we can analyze, that we can diversify, and that we're well paid to take. And that's basically what I've been doing all my life. And when I started work in 1969, the banks invested in what were called the Nifty 50, and they thought they were investing risklessly in the best companies in America because of the quality of the companies. And if you held those stocks for 5 years until 74, you lost about 95% of your money. And so these people were taking risks they were unaware of, and that's the worst thing you can do. Keynes said that a speculator is someone who takes risks he's aware of, and an investor is someone who takes risks he's not aware of. We want to do it knowingly, not run from it, but and try to emphasize in the long run risks that are tolerable in quantum for us, and hopefully, as Sheikh Saud says, underpriced.
And something similar happened, I guess, for many people who were holding the developed country sovereign bonds, thinking they were risk-free, going into 22, 23. Sheikh Saud, okay, this is all very nice, but people will be interested in how it applies to practical decisions you have to make. And one of them came up as we were talking just before we came on the stage. A lot of people are talking about sell America, or at least diversify a little away from America. If you're thinking about whether that's correct, how are you approaching that? How do you think about America as an investment destination right now?
I would say it very bluntly, underweight America at your own risk. Because people tend to talk about going underweight the US, and the question is against what? Relative to what? They're mainly looking at equity markets, but they're not taking into fact the US has the largest fixed income market, the US has the largest private equity market, the real estate market, infrastructure and credit. Where is all those capital? Where is the capital going? And I think the US has the breadth and depth to sustain its exceptionalism. And it has the rule of law as well. That still applies. So I would reiterate, underweight the US at your own risk.
So does that mean that Kuwait will be joining the list, making commitments to invest in the US?
That's a trick question, but
no, it's a very straightforward question.
It's a very straightforward question, and it goes back to your process and strategic asset allocation. If you developed a forward-looking strategy and put a process around it, you don't need to be reactionary. If you are already there, you don't need to be joining. That's how I would phrase it.
But just because I'm afraid there has been some talk about this, can we expect to hear an announcement that Kuwait will be joining the countries in this region who are committing to the US, big numbers?
The US is the largest, I would say, capital markets of the world. So obviously you'd have to be there. And if you want to grow, you have to grow with the US. So naturally speaking, as those capital markets develop, you'd be allocating towards them as well. And we've been allocating to the US for a very long period of time. And I don't think that's going to change.
Okay. Howard Marks, how do you think about, you'll probably say it's the wrong way to think about it, but how are you thinking about the US as an investment?
Well, look, the words US exceptionalism are on everybody's lips these days. And, the US has really been preeminent in the world for the last 80 to 100 years, based on dynamic economy, respect for the free market system, respect for the rule of law, capital markets, spirit of innovation, many things. Those things haven't gone away. I think that the U.S. is still the destination of choice, and it is the majority of the world economy. It's hard to imagine that it shouldn't be the majority of anyone's investments. Exactly how you turn that into a number, that's where the judgment comes in, and it can't be the subject of an algorithm. The world is going to have to decide whether what I said while we were warming up is that the U.S. is the best place in the world to invest. The question is it still as best as it was? And that's a judgment. Are we as dependable as we always have been? That every person has to answer that for themselves, and obviously that's a big topic today. But I can't imagine how a large, globally oriented fund could make a substantial reduction in the U.S. Everything has to go someplace. Where would it go? What's better?
So this is but most investors, and I would say this goes across even by scale from the smaller to the larger, would find themselves today disproportionately invested in the US relative to GDP, relative to many other things that you would measure. So if it is at the margin less attractive now than it has been in the last 20, 30 years, just in terms of sort of upside potential, is that something that could affect your overall allocation?
So this is how I would phrase it. So let's theoretically speaking, let's say you would say the equity markets are less attractive. You're going to take capital from somewhere and put it somewhere else. So you might take it from US equity market, but put it into US infrastructure. Mm-hmm. You might take it and put it in private equity, private credit. So it's still staying in the US, and it might even grow. So the question is just asking yourself the question, where is it going to go to?
And public versus private? How do you think about that?
That's a very interesting question, and I'm going to give you opportunities and risks in both sides of the market. So in public markets, I would identify the main risk is index investing. And the reason I say this is if you go about maybe 10 years ago, the top 5 names in the index made up maybe around 14% of the weight. And because of what maybe Howard described in his memos and sea change, public markets and indexing benefited from beta and liquidity over time. And a lot of flows went to passive. And that generated momentum. And the top 5 names right now make up maybe 30% of the S&P 500. You think that's a big number, but that's not even where the risk is. The 30% are extremely correlated to one another. And it's like adding leverage onto it. So it's like a double whammy. And we've seen how that impacted when the news of DeepSeek came, how the market dropped. And that's a signal you'll pay attention to. And how do you play around it? I would go by saying, I think active management is back. And I think that's how you play around. It might sound counterintuitive, but you would reduce your risk by increasing your tracking error, because you would move away from, you're able to move away from these names. If you look at portfolios over the past, of maybe let's say last year, I just need to know one thing to know if a manager has over or underperformed their benchmark. Did they hold 6% NVIDIA in their portfolio? And that's the only thing I need to know. And in public markets, if you want to compare between debt and equity, it depends on the price and where you want to be in the capital structure. So on average, and over average is a very, I would say, dangerous word to use, but equity markets return 8% over the long run. If you look at what happened in April, high yield, even if spreads were not at historic levels, the all-in yield was maybe around 8%. And you're basically getting equity-like returns, just being up the capital structure. But you have to be ready, and you have to make a decision when that opportunity comes up. So that's on public. On private, it's a whole different story. I believe private equity is very troubled. And I believe, especially in the large buyout, venture capital, and let's say the rise of continuation vehicles, that's a very worrying sign. And private equity is in trouble because they got away of doing mistakes for the past 5-10 years without paying the price for it. And I think their time is coming up. And that's for maybe three key reasons. One is very poor underwriting with no process around value creation, but relying on beta, leverage, and multiple expansion. And in private markets, I mean, we love the GPs that we work with, but when they do something right, they tell you about it and they brag about it. So I would ask LPs to ask their GPs to let them show them their underwriting process and at what multiples have they been buying in their various vintages. And if they refuse to show you, they've been doing something wrong. Because they brag about it if they're doing something right.
What's your exposure now? Is that something, so you're looking to reduce exposure to private equity or just not expand?
No, I would say private equity is a very broad set, and I'll explain later on where the opportunities lie in private markets. I think the risk mainly is in the large buyout and in VCs. And one is poor underwriting. The second part is underwriting with no exit optionality. So when they underwrite a specific deal, they look at one exit path, let's say an IPO. Now, what happens if that market is shut? The third part is size drift. We've been seeing private equity funds grow up in size in time with the same number of portfolio companies. You're seeing them coming up at 10, 15, $20 billion in size. If the base case of underwriting is 2 times your return, it means you have to be realizing $40 billion worth of assets. Question is, who's going to buy them? And the answer is, I don't know. You put them all together, and you have the perfect storm. And this is what we have right now. You have $3 trillion worth of portfolio companies that are yet to be realized. And the worst part of it is they're approaching the end of their fund life cycle. The clock is ticking.
Well, the clock keeps getting pushed forward in some cases.
With continuation vehicle, but there's a limitation. Now LPs are asking for their money back. The clock is ticking, And buyers, on the other side, are being paid to wait.
You know, I think the thing to bear in mind is that we went through 40 years of interest rate declines. And when interest rates decline, valuation parameters go up, the cost of capital goes down. So the ownership of assets using borrowed money has a tailwind. I've described it as the moving walkway at the airport. It carries you along and you think you're making great progress. But declining interest rates obviously can't go on forever. They can't be the norm forever. And in a stable interest rate environment, like I think we're looking at prospectively, the special returns will go to people who can find underpriced assets and add value. And that's where the reward will be. And that's how the private equity industry will have to distinguish itself in the years going forward, not just buying, levering, and benefiting from appreciation.
And that's why you're seeing opportunities come up in secondaries and in special situations. Is to provide solutions for LPs and GPs to get out of the problem that they're into. So that's where you're asking, okay, where do you go in private equity? I would say secondaries, I would say, is in a golden window opportunity because of not because of events that are happening today, but because of mistakes that were done maybe 5, 10 years ago, and now they have to pay the price for it. And the price probably is going to be steep.
This is why I'm reminded of my conversations with my teenage daughter as she starts to discover fast fashion. And it's trying to teach her the difference between something being cheap and something being good value. But Howard, on this private-public difference, and I think a sort of related point of liquidity.
Yes.
You know, we talked about indexes. One of the things that has pushed indexes up is it's sometimes illusion of liquidity, certainly the overvaluation of liquidity.
Right.
Now people tend to say, okay, you have to, illiquidity is the price you pay for having a return. Do you think that's still true? Do you think that's where the future is?
Well, in a normal market in which people are appropriately averse to taking risks, and including the risk of illiquidity, there will be a premium for taking it. And so that's a reasonable way to make money, as long as you don't underestimate the need for liquidity. I mean, the worst thing you can do is tie up money that you can't get out, which you might need. And, you know, Mark Twain said, history does not repeat, but it does rhyme. And one of the themes that rhymes from cycle to cycle is that when things are going well, people underestimate risk and they overestimate their ability to live without liquidity. And when things go wrong, they say, yes, now I understand why they pay you extra to take on illiquidity. You know, what you have to do is you have to be introspective and you have to realistically appraise your ability to live without liquidity. But liquidity is a real thing, and it's not just a number on a page. There might actually someday be a need for money. Now, you probably don't face it because you have a growing corpus, and it's going to grow for future generations. But everybody has to be at the right place on that subject.
You mentioned, Sheikh Saud, that the DeepSeek was an important signal to follow. How are you thinking about AI and allocation to that part of the market, to technology?
I think that's a very good question. And I think you can't, I would say, buy AI itself. I think AI is a big theme. I think the question is how do you get exposure to it and at what price? So you can either get exposure in owning the companies that develop the technologies, or you can get exposure through the enablers that help AI grow. And I'm going to talk about just briefly the risk-return profile where you're getting it. I think the best way to get exposure to AI right now, maybe even as sovereigns and large allocators of capitals, is investing in the enablers of AI. So investing in data centers, power. Power is going to be the main issue, connectivity. I think those are the main exposures. And going back to what we were saying is you want to compare between owning an asset and lending against it. I mean, even in infrastructure spending in AI, even if it's classified as equity, the main opportunity is actually in lending. And by lending, I would say, is basically you would go out to a hyperscaler, you'd say, I would build you your data center and lease it out to them contractually speaking. So it looks like equity, but basically you're getting paid on a fixed income instrument by leasing it out. You're getting paid 10, 12, 13% IRRs on a single A, double A rated hyperscaler. That's a great way how to play AI, in my opinion.
Howard, AI?
You know, what I say is I don't think that AI knows everything that's ever happened and how stock prices reacted to everything that happened. So they can emulate the path to success that worked in the past. That's a pretty good skill to have. I believe that AI can't sit down with 5 business plans and figure out which one's Amazon. I don't think they can sit down with 5 CEOs and figure out in advance which one is Steve Jobs. So there are limitations. But of course, most people can't do it either. So I think that just like indexation and passive investing has supplanted much of active management in the large cap stock world, I think that AI will supplant a lot of investing and a lot of investors, but hopefully not the best.
Okay, last question, and you've sort of raised it. Both of you have talked about the mistakes that people typically make, and good investment being about avoiding those mistakes. But I guess good investment is also about recognizing that you too will make those mistakes. So what have you got wrong in the last couple of years?
So I think what you said is absolutely right. And I think it's always about everyone would do something wrong. You can't avoid doing something wrong, but the important is when you do something wrong is to refine your process along the way. And in hindsight, everyone has 20/20 vision, but no one can predict the future. So you need to focus on your process. But I would say two key takeaways for a long-term investor is that it pays off to actively decide to be patient. And sometimes the best investment decisions you make are opportunities you don't pursue. I would put it that way.
But what have you got wrong?
What have we got wrong? See, we've been around for 72 years.
And you made no mistakes?
We always make mistakes, but we learn from them. And I think it goes about sometimes you need to keep refining your process, and sometimes you get carried away when things do get right, that you think you're getting them right, but you don't know if it's luck or skill. And I think as now the easy time of making money is over, you need to keep refining your process the whole time. I think that's what we've been focusing on. I mean, I'm privileged to have a great team working with me, and we've been focusing on process a lot. And I think that's the key thing. People tend to forget about process when things are going right, and they tend to panic when things are going wrong. If you keep your process there and have a playbook and a game plan, you should be ready when the opportunity comes. And I think, to be honest, as the KIA, we've always been ready when things went wrong. I think we've been great beneficiaries of the financial crisis. Maybe we've learned from our mistakes on .com, but in the financial crisis, the KIA played a big role in bailing out the financial services industry. And this man as well has made a lot of money in the GFC. Okay. So I think there's a few things we have in common.
We've not had a concrete example. Well, maybe 25 years ago in tech is the last time you made a mistake, is by the sounds of that. But Howard, very briefly, we're getting shouted at to leave. But where have you, what have you got wrong?
Well, you know, look, we all have our biases. We can't escape them. The most important thing is to understand them and limit their effect. I am a conservative person, and I'm a skeptic with regard to new and not obviously meritorious developments. So that hasn't been a good thing in the last 15 years. That would have held you back in the last 15 years. So I've had to suppress that, and you know, I can't always do it perfectly.
Okay.
I still think those are good values, but sometimes they get in the way.
Sheikh Saud, Howard Marks, thank you very much.
Thank you.
Thank you.
Please welcome to the stage Katie Koch, President and CEO of the TCW Group, and Rajiv Misra, founder of One Investment Management, for a conversation with Bloomberg's Jumana Bersetchi.
Hello. Really looking forward to our panel discussion, riding the macro wave, what's coming next. I actually want to start with what happened on Friday, Katie.
Okay.
We had Moody's downgrade U.S. sovereign credit rating. There is no single credit agency that has a AAA rating for U.S. credits, and you are seeing a reaction in fixed income. TCW, of course, fixed income focus. 30-year yields are inching back towards 5%. How big of a deal is this, especially because there's so much scrutiny now about the trajectory of the U.S. fiscal situation?
Sure. So thank you for that, Jumana, and it's such a pleasure to be here. I'm always delighted to be back in Qatar. As was mentioned, I'm the CEO of TCW. We're a global asset management company. As also mentioned, we manage a lot of fixed income. So I feel like we have some good perspective to answer that question. And we've also had the privilege of managing assets on behalf of beneficiaries in this region for 40 years. So moving on to Treasury markets, I'll tick through very quickly what happened, kind of why it happened, impact to markets, and how we're positioned. And I'll do it very briefly. So what happened? Obviously, we got a downgrade. It's not new news. It's the third downgrade to U.S. It's the last one of the major rating agencies. The first one happened more than a decade ago. But that was announced, as you said, at the end of last week. Why did it happen? I think the most simple way to think about this is looking at the credit of any organization. If you want to maintain your credit rating, it's usually a good idea to have revenues that exceed your expenses and not to alienate your lenders. We did a lot of that in the U.S., and this is kind of the result of that happening. Just to give context to people, because rates have stayed elevated, the interest burden now in the U.S., we spend more on that than we do on the military or Medicare. So this is quite a burden. And then to end with, what are the implications? There hasn't been a massive shift in the short end of the funding market. We think that the implications here are that volatility is likely to stay elevated, term premiums likely to stay elevated, and curves will steepen. And then ending with how we're positioned around that at TCW, this is what I would say. When we came into the year, we were a little bit overweight duration at the short end of the curve and our maximum underweight position in credit.
Yeah.
And why was that? It's not because we were geniuses or we foresaw what was going to happen with tariffs. It's actually because we said, even if all these things are true, even if we get animal spirits and we get deregulation and we get tax cuts, markets are already priced for perfection. And that led us to come into the year in both public as well as private markets underweight credit. And then when we got the dislocation, we had our busiest trading day in 50 years and added to our credit positions in both private as well as public markets. And I'll just end by saying, you asked, what happens from here? I do think that risk assets, whether it's equity markets or credit markets, are too complacent, and that the soft data will eventually catch up with hard data, and we should get more opportunities to take advantage of dislocation.
Okay, I'm going to put you on the spot. Would you buy 30-year U.S. yields at 5%?
No, we are underweight the long end of the curve, and we are overweight the short end because our view is that we will have eventually, and it's not a catastrophic, we just think there's going to be a business cycle, and when that happens, the Fed's going to have to cut rates, and they can move the short end of the curve better. So we're overweight slightly the twos and the fives, and underweight the longer end of the curve.
And just on the outlook, you expressed some concern about the trajectory of the U.S. economy. Where do you think the downside risks are going to come from?
I do think that, you've seen, when I say the soft data, just to be specific, we had the worst reading ever second worst reading ever in the history of the U.S. of consumer sentiment. The hard data hasn't yet caught up to that. The tariffs are not going to be as bad as we thought on Liberation Day, but they're still not going to be zero. And I think as we get more data that comes out, markets aren't priced for disappointment. They're now back to kind of record tights in credit and close to record highs in equity markets. And we would just say that's incongruous with the likely data that's coming out. And I just want to go back to the fact that for what we do, this creates volatility and should create tremendous opportunity to step back into the market, because the most tested way to create wealth for people long term is to step up and be a liquidity provider when other people can't or won't. And we have a strong view. We did it already in the second week of April, and we just think the market's going to give us more opportunities to do that in private and public markets.
The snapback in credit has been pretty pronounced. Rajiv,
Yes.
let me turn to you. If you were an investor and you'd bought Magnificent Seven in April during the peak volatility, you'd be up 30%. If you bought NVIDIA since mid-April, you'd be up 40%. I guess maybe the takeaway here is, and you can respond as you see fit, but don't underestimate U.S. tech.
Well, thank you for having me first, and give a little context on One Investment Management. We don't invest in liquid assets. We do more private investing. And I did that for 10 years as CEO of the Vision Fund before that. So we don't take short-term views on where the markets are going. We were long NVIDIA when it was a $30 billion company in 2017, our biggest position in the Vision Fund. And now in One Investment Management, I believe, as Katie said, there will be volatility. The market is priced to not perfection. There is enough risk premium. We have positive real rates. Inflation is at 2% and 10-year treasuries are at 4.5%. So the US, if you go back last 10 years, had negative real rates. So you're getting paid for taking risk. But you have to look at kind of the macro environment and say, where are the dislocations? As I was listening to Howard Marks before me, been reading him for 20 years. How should you be positioned is important over the next 12 months. It'll be volatile. It'll be anything but boring, okay? Go in where there is structural deficit of capital. What's happening in the US, if you look at US, Europe, the large economies, the liquid markets, you have thousands of regional banks who have withdrawn capital because of rising rates, and they were hoping that rates will come down and bail them out in 2025. That's not happening. So their books are still underwater with 2% loans. So the regional banks are not players in the US, which is by any day the largest market to invest in. Hence, there are plenty of opportunities to fill that capital gap with providing capital to different asset classes, real estate, construction, of housing. There's a structural deficit of houses in the US. To corporates, middle market corporates, to growth companies. It doesn't have to be NVIDIA or Microsoft. And the last thing I can talk about is predicting markets as to where it's going to go. There's a lot of retail hype and froth in the market too, with a lot of people who made easy money in 2024 spending a disproportionate amount of time becoming investors and trading electronically. But my advice would be keep enough capital aside. There will be dislocations, and be patient a couple of times a year and take advantage of that. When there was a dislocation in April, we looked at what could we buy that might have mark-to-market volatility with price, but won't lose money even if a 2008 happens. And there were triple B CLOs, double B CLOs, other liquid structured assets that we knew might go down another 10 points, but won't lose money over the next 4 years. And they traded extremely cheap, and you could buy $1 billion of those.
Yeah. Let me ask you about artificial intelligence and whether you think investors are sufficiently discounting how disruptive artificial intelligence is going to be to our lives.
No, we're sleepwalking into the disruption. So,
we're sleepwalking into disruption.
Correct. Because, and the generative AI right now are the large ALM models, OpenAI and others. And that's just the foundation stone, but it is moving fast. If you look at last week's news, Microsoft laid off thousands of software programmers across the globe, India, US, in Seattle. And you would think, if you went back last 5 years, and I am a member of the board of the UPenn advisory board, of the 400 undergrads who came in to study engineering at Penn, 80, 100, 120 would do computer science. Nobody wanted to do mechanical engineering and so on. So, but that's not the issue. Every white-collar job which is process-driven, what generative AI is good at is it has become good at answering questions. It's not good at, you still need Katie to ask the right question.
By the way, that's what I say to my kids when they go to school every morning. Ask good questions.
Yeah.
Humans still have to do that. I agree with that.
But to give an answer, they have processed every book in the world, every data in the world. So they are 1 million times more information than a human being can ever hold. So they can answer the question. So it now takes weeks to process a mortgage application, an insurance claim, medical claims, even in asset management will get disrupted. When we do lending, and if you go to a large alternative asset managers today, there are hundreds of people monitoring loans, monitoring assets, risk managing, so on. The computer will do an amazing job and bring down costs dramatically, bring efficiency in. Asset management, and as Katie would tell you, is a scale business. But scale may not be that essential anymore if it's generative AI, because the cost of doing business will come down dramatically. So the punchline is there are tens of thousands of businesses, mid-cap, small businesses, others. And when we invest equity or lend to them, we look at their last 5 years of financials. What is the free cash flow, EBITDA, profits, how much debt can they bear, what should be the equity value? But that need not be the next 5 years, because they will get disrupted. Because if you're a company that's processing mortgage claims, that's processing medical claims, that's doing actuarial work, aircraft leasing, what have you, which are human, white-collar, intensive jobs, the computer will do it better.
Katie, the thesis of America Inc. outperforming the rest of the world got tested in the last couple of months. And you see it in the performance of some of those key financial assets. There has been a recovery of sorts, as we just spoke about. How are you thinking about investing in the US versus the rest of the world right now?
So I think, just breaking this down, there's this topic currently about US exceptionalism and whether it's been permanently damaged and whether that's going to alter the risk premia. And so I want to kind of just say like what my view on what US exceptionalism means, and then I'll talk about how we invest around that. So I think there are kind of 5 factors that have made the US a really exceptional place post-World War II. The first is that we had very strong alliances. The second is, very quickly, an act from 1950 called the National Science Foundation Act, which, making it short, was just connecting research dollars from universities into the private sector. That has given rise to a lot of the technologies that Rajiv just talked about. Third would be the exorbitant privilege of being the world's reserve currency. Fourth would be rule of law and constitution. And fifth would be demographics, that as a country, we in theory can tap into 7 billion people, whereas China, the world's second largest economy, has a smaller pool to come from. That's historically been true. I think we could argue we're taking all of those out for a little bit of a test drive right now. But ultimately, I think while some of those formidable advantages are bendable, they're probably not breakable. However, I think both things can be true. I think the US can remain exceptional, and I think it's still possible that investors are going to look to allocate marginal dollars elsewhere. And I'm going to complete that thought, and if we get a second, I want to say something on AI. And what I mean by those marginal dollars is the following. Like, there's a lot of talk about whether we're losing or we're winning. I just want to posit to people that the United States of America has 5% of the world's population, 25% of its GDP, and over 70% of its market cap. So we came into 2025, one might argue, with actually a lot to lose. And I really dismissed the concept that people would allocate away from the US in January. I just said, that's not possible. We are the world's reserve currency. We have all these formidable advantages. There's nowhere better to allocate capital. I actually still think that's true. And the middle market, which you talked about, is, if you add it together in the US, the third largest economy in the world. So, I mean, there are amazing opportunities. But what I'm hearing from investors all over the world is, yeah, America's great. And it may stay great. But maybe I don't need to put more than 70% of my capital into that equity market. The UK pension market currently has 12% of its assets in 7 companies that are American. So I just think a little bit of the disruption and chaos has made people look at the portfolios and say, maybe we would, benefit from some diversification. And I'll end by saying a place in this region that we actually are seeing a lot of interest is in emerging market debt as an example, which has actually outperformed, as has Europe, the US in debt markets, surely, and in equity markets as well, in the case of Europe. But back to emerging market debt, half of that index is investment grade. So you have a lot of people, a lot of LPs looking at that and saying, do I want to be with the US IG credit facing tariffs and slowing economy? Or might I be with an IG credit in emerging markets where I can get similar or higher spread? Look at this country, in Qatar. You have a good quality credit that's actually deleveraging. So I just think people are open to the benefits now of diversification.
Yeah.
And can I just say one thing on AI before? Do you mind if I wanted to make one comment on what you said? Because there was a chart up before about the Mag 7, and have so much more experience in technology investing than me. But one thing I wanted to say, when we look at the future of AI, and we've had a dedicated AI fund for 10 years, I completely agree with what you said. Currently, we have like 70% in the infrastructure, which, by the way, was money losing for the internet. So time will tell. Like, we think this is different. We should argue that. But we have 20% in the software and 10% in what I would call the adapters to it. And I think that's going to shift a lot. And we agree that the winners are going to be the companies that figure out how to adapt themselves. This is a very important point. It might be real estate. It could be industrials. It might be hospitals that could be the winners of that revolution.
Financial services. A lot of industries need to be disrupted. So agentic applications of AI over the next 5 years is where the fund will be.
Yeah.
The companies that apply generative AI.
I want to ask you about a sort of parallel theme, because data centers require a lot of power, a lot of energy. And what has happened in the last year or so, the last 6 months, is the hype around energy transition, around ESG, has fizzled out. But when I speak to people, especially in this part of the world, when they talk about investing in data centers, they tell me a lot of that is actually going to be powered by renewable energies, by potentially nuclear energy. Is that going to give the energy transition basket another push?
Absolutely. And the push for green was good. We will need a lot of energy for many reasons. Data centers, we have 8 billion people on this planet, and of which 3 billion are becoming affluent in India, Southeast Asia, China, and in Africa, whose per capita consumption of energy is going to go up as they become affluent. So the demand for energy is going to go up dramatically, not just because of data centers, but because of human demand for energy also. They're going to fly more, they're going to consume power more. And hydrocarbons will always be important, and there are cleaner forms of hydrocarbons, like natural gas. But to me, the cleanest energy source always, there is hydrogen, there are other technologies, it was always nuclear. And I have seen quite a few companies, without naming names, who are doing small-scale modular reactors, SMRs, which require 5 acres of land. One SMR produces 320 megawatts. So if you put 2 SMRs, they're underground, so even if there's an accident, there is no spillover. The time to from start to finish takes 3 years to put a plant together. It doesn't take multiple years with a lot of resistance from the neighbors, etc. It can be in the middle of nowhere where there is a grid. And so 2 SMRs with 650 megawatts can fire data centers and so on. So I see by 2029, the first SMRs coming on steam and producing energy, and there'll be thousands of SMRs in the 2030s, which will fuel and kind of fill the gap for the energy shortage that is.
Interesting. Katie, I want to ask you about private credit. You touched on it briefly at the beginning, at the start, and there's so much interest and so much money going into that space. Is it becoming more difficult to find opportunities?
I do think it is. First of all, I really appreciate Rajiv's endorsement for the asset class. And if private credit's like...
That's what we do for a living.
Endorse asset classes?
Yeah. Well, and allocating, but also just, you know, you've been very prescient on and getting lots of the parts of the technology market right. So I appreciate your endorsement of the exciting U.S. middle market. And we do think that there are opportunities there. You asked if it's getting crowded. I do think there are parts of private credit that are getting crowded. There is some optimistic lending happening in the large cap sponsor space with a lot of money probably chasing too few deals. And so my advice to everybody in the audience is to be looking for unique sources of origination. This is very important, like what is the origination edge? This is why we've done a JV with PNC Bank, which is the #4 middle market lender in the US. It's to get unique origination with less dollars chasing the deals. I would also say in private credit, the covenant is the asset class. It is the thing that made it different from liquid QSIP credit. And a lot of the market has given that covenant away. So you really want to push your managers on what is the underwriting, do they have strong covenants, and if we do have a business cycle, which we think we're going to get, do those covenants and does that documentation give them the ability to get to the table to work out on your behalf? And do they actually have experience of working out on your behalf? Because our view is we are going to eventually get some business cycle. And 90+% of private credit managers started post-GFC. So they've invested in a very benign environment for credit. And we would argue that things are getting rockier. And let me just end by saying, picking up on something that Rajiv pointed out earlier, which is finding out where there are gaps in the market, where capital's scarce. We think one of the best opportunities right now, really for looking out the next 10 years, is in rescue finance in parts of the US middle market. So even in the absence of a business cycle, you have companies with upside down capital structures put in place by private equity post-COVID, and a third and rising of our market cannot even cover its fixed interest charges. So you can go into those companies, get a high current coupon, get PIK, get warrants to be an equity holder. This is where the returns are in the complex and highly structured part of this market.
That's a great place to leave it. Oh, Rajiv, one more, go on.
Let me finish on private. What is important, whether it's private credit or any private asset, is be solution driven. Don't go into a situation which is competitive where five lenders are bidding to lend them money. Then you have no competitive edge. Yeah. Be solution driven, provide solutions to, and it doesn't have to be corporates. Private credit can be asset based, aircraft financing, shipping finance, leasing, real estate construction for homes, lending to corporates. Give them a solution where they're not able to find a willing lender. If it's 5 lenders vying to lend to them, back off.
That's good business advice. Panelists, thank you so much.
Thank you.
Sure. Thank you.
Please welcome to the stage Marcelo Claure, co-chairman and partner of Brightstar Capital Partners and CEO and founder of the Claure Group. Jenny Lee, Senior Managing Partner of Granite Asia, and Stephen T. Mnuchin, Founder and Managing Partner of Liberty Strategic Capital and the former Secretary of the U.S. Department of the Treasury, for a conversation with Bloomberg's Eric Schatzker.
Well, good morning, everybody. It's wonderful to see you all here at the Qatar Economic Forum. You can see who my panelists are. I don't think I need to introduce them for a second time, but I'll provide a little bit of context. This panel, as you've seen, is called Hunting for Growth. And I don't need to tell all of you that these are uncertain and to a large degree unpredictable times. The markets, it's fair to say, have been struggling to see beyond policy shifts and through the resulting fog of confusion. And that's why we asked Stephen and Jenny and Marcelo to join me here on stage to help paint a picture that makes sense for people who are willing to take risk in search of growth. Now, before I turn to my panelists, I do want to remind all of you that we'd be delighted to hear from you. A little bit of input in terms of questions from the audience would be most welcome, and they'll come to me and I'll do my best to weave them into the conversation that I'm about to have with these three people here. So don't forget. I think it would be helpful, as I said, to establish a little bit of context, so I want to do the whole elevator pitch thing. I'm going to ask each of our three panelists to tell us in one or two quick sentences who they are and what they specialize in as an investor. Stephen, would you like to begin?
Well, first of all, it's great to be back in Doha, and thank you for hosting us here for this session. At Liberty Strategic Capital, we're mostly focused on technology and financial investing, particularly banks and insurance companies, and in technology across everything from data centers to cyber.
Jenny.
Great. Hi, everyone. I'm Jenny. It's great to be here. You know, as we were coming on stage, I realized that if you want to be an investor, you should be wearing running shoes. Because part of being an investor is you got to just run faster than most people. You want to get ahead of the trend. So Granite Asia, we are a global investor, early venture and early growth. And so what we do is we look for the best entrepreneurs, help to grow them as they grow from 0 to 1 to IPOs and to public. That's what we do on a global basis.
Marcelo.
I'm Marcelo Claure. I have a few different businesses, but where my energy sits today is having the ability to buy companies, apply AI, turbocharge them, and generate a lot of returns for our family office and my investors.
Terrific. And I would just point out, in addition to what Jenny said, that yes, if you want to be an investor, you need to wear running shoes, and if you want to be a moderator,
precious.
What I'm most interested in, and I suspect what you're most interested again, is growth opportunities. I want to know from our panelists, what is the single best investment opportunity in the world right now, regardless of industry, regardless of region, that you see, why, and how you're making it available to your clients? Marcelo?
I would say that today, everybody talks about AI, right?
They do.
We have to learn how to divide AI.
Ad nauseum, I might add.
I'll say that most of the money, about $350 billion a year, go what I call the factory of AI. And that is, people are investing in power, investing in data centers, investing in semiconductors, LLM and applications. And it's incredible. Think about it, $350 billion a year. What I'm focused on and what I do believe single-handedly will be the most value creation is in enterprises that have the ability to grab the technology and be able to implement it, what I like to say, apply AI. And we have a really good use case. I'm very lucky to be the largest independent shareholder of T-Mobile in the US, and we made it publicly that through a digital and AI transformation, we're going to generate close to $10 billion of profit. So put things in perspective, it has taken us about 120 years to get $30 billion of profit, and it's going to take us 3 years to add another 10. And what you can do in use cases, in customer service, in sales and marketing, in software development, in the back office, in supply chain management, and so on. And the reason why I say it's the absolute best investment is because what we do is we buy good companies and we make them great. So even if we don't do such a good job, we will always have a great company. So I've moved from being a venture investor or growth equity investor to now I see the single-handedly as the most important investment will be in buying incumbents who have an edge and be able to apply AI and make them great.
A couple of follow-up questions. What's a good example of an incumbent? How could you take a company that we might, or an industry that we might know and understand, and turn it into something that's so much better than what it is today that you can create the kinds of returns that you're talking about?
I'll give you an example. A company in the US called K-Health. Today, we're the primary care physician of the world's leading hospitals, Mayo Clinic, Mass General. And the way it works is our AI will ask you the right questions about your symptoms, be able to combine it with your electronic medical records, combine it with our clinical AI, and in less than 5 minutes, we have the ability to diagnose a patient, prescribe, and develop a cure. And what we do is we grab that information and we pass it on to the doctor, because the doctor, at this point in time, will have the final decision. So what does that do? It drastically reduces the cost to provide service by 90%, and it also provides a much better quality than when a doctor was doing it on his own. So the results are radical. I mean, think about it, 90% reduction while enhancing, that's the power of AI, while enhancing the quality of care that we do. If I go back to T-Mobile, you know, the quality of service at a telco that you're able to provide customer service, when you have something called proactive customer service, what does that mean? AI, on a just-in-time basis, is able to predict if there's going to be an issue with the customer and fix it before it happens. Very different than you calling a customer care and complaining about my bill or complaining about I drop a call and all that. So these are real use cases that we as investors are so lucky that somebody else is investing in the factory of AI.
The second follow-up, why is a telco, why is T-Mobile, a wireless services provider, the right platform from which to operate?
Well, I'm very lucky to be, like I said, the largest independent shareholder. And when you have a company that has 130 million customers, a huge proprietary data set, then you're able to innovate. And we have deep partnerships with OpenAI, we have deep partnership with NVIDIA, and we've done some pretty incredible things. I do believe that the T-Mobile AI transformation, it is basically the largest transformation of its kind. There's no other company in the world that can say, we are going to generate an excess of $10 billion through a digital and AI transformation.
You're right, it's a bold claim.
And again, it's public. Go to our investor relations, see it. I mean, the management team committed to that number. So what happens when we do that? So some magical things happen. You start trading at 11.6 times, while every other telco trades at 6 times. You start generating profit at an accelerated pace that others don't do. So T-Mobile, healthcare, we can go on. And I think for the next 5 years, what we're going to see finally is the technology is there. It's amazing, right? And the winners are going to be the ones that have the ability to apply AI to existing legacy businesses.
Jenny, same question to you. Single best investment opportunity you see in the world, regardless of industry or geography. Why? And again, how are you making it available to your clients?
Yeah, so Ari, I'm going to answer your question separately. I think we saw for early stage venture and growth venture. So it's very hard for us to pick one company.
And you have to spread your bets, right?
Yeah, exactly. So for us, it's not about spreading the bet. It's really about looking at the ecosystem. And so when you are solving for early stage and early growth, what's very important for us, I think the key criteria, and this criteria has changed, is number one, talent, and where the talent is. Having played globally and invested globally for the last 25 years, today for sure, I think Asia is the place to be. So if you look at Asia broadly and the level of STEM talent from China to India, here, Middle East to Southeast Asia, we're talking about 6 to 7 million of STEM talent being groomed here on an annual basis, right? So that's a lot of, and I know we're talking about AI, we're talking about AI replacing talent. At the end of the day, businesses are still built initially by humans. And so I think the level of talent is very important. So this talent is here, this talent is hungry. And I want to add that with the world order being restructured, there's also an inflow of new talent coming back home, right? Whether it's back to the Middle East, whether it's back to Southeast Asia, whether it's back to China or to India. I think that's happening as well. With hyperscalers cutting off headcount in the US, there's also a lot of skilled talent, the likes of those who have experience from Microsoft to Apple actually coming back. So I think number one, talent. We're seeing enormous talent flow back to this region, which gets us excited. And this is across the board, number one. Number two, markets are being reconstructed, right? In the past, US-China, homogeneous market, huge market, growth markets, that's where a lot of the innovation is happening. But today, the markets, whether it's building bridges from the Middle East to Southeast Asia, China to the Middle East, those bridges are being reconstructed in a very cohesive, friendly manner as well. And so I think we are starting to see the appearance of huge emerging growth markets other than the huge markets that we know, and I think that's a very important part. The third, where's the capital? Now, while a lot of capital has been flowing back to the US, whether you're overweight US or trying to diversify, I think for sure, US is going to be benefiting from a lot of the capital flow. But it's also true that countries are realizing that we have to keep the talents here, the ideas are here, the capital needs to be in line here as well. And therefore, the developmental effort by a lot of countries here in this part of the world is very important. So those are key criteria. Now, when you put that all together, I want to say that the trends, and I'll just highlight two trends, not one company. The first trend is that we see from a venture land that innovation is going back to foundation and fundamental technology. Now, why do I see this, right? We talk a lot about semiconductor. Now all of a sudden, all countries realize that we better have some semiconductor capabilities. And what's happening, right? So when I say back to fundamentals, the 28 nanometer process node for foundry is back in vogue. You don't have to be 3 nano if you have nothing. You start with 28 nano. And so if you just track where are the 28 nanometer foundries being built, today you have TSMC in Japan, you have India with the Tata Group coming out with their, taping out very soon with their 28 nano, Malaysia announcing, Singapore announcing strategies, and I'm sure here in the GCC as well announcing. And what that does is it allows basic fundamental technology that we thought we don't need. That's coming back in vogue. And I think that will crystallize the talent in fundamental technology. And so along that stretch, and this is actually clearly the foundation of AI, as we talked about, right? You have basic access to basic chipset. We may not need the 10 to 23 compute power, but basic technology that people are starting to learn. And on top of it is data, right? We have proprietary data here. Every single country has your own specific small language model. We don't need large language model. The LLMs are open source. You can access, compute at a very affordable cost today. So then it's about how do I then build the infra, build the technology, have the data, have the right rules, and then allow the ecosystem here. You have the talent, we have the talent. So I think that the one theme is around AI, we are actually going back to fundamental building block of the technology stack. So the entire technology stack, in our view, is being reconstructed. May not sound sexy, we're not going for the moon, but right now I think it's really going from 0 to 1 to 2. And in that AI construct, one particular area that we as a firm is very focused on is the whole concept of agentic AI plus robotics. And I think that this is also one area that Asia as a whole has the right to win, right? First, we have manufacturing capability here that allows us, whether you're building humanoid robots or machine-looking robots, at a very good, scale-efficient, affordable ecosystem pricing as well. That's number one. Number two, many of the countries here don't have the luxury of being able to put people back into factories. And therefore, whether it's here in Qatar, right, 300,000 in terms of population, my home country, Singapore, 5 million, we don't have the human power to be able to compete to do everything. But agentic AI plus robotics allows us to build this automation capability that can allow us to 10x our labor capability in a way. And so being able to now, imbue our robotics with the right, generative AI or agentic type solution, I think it's actually one way for this region to actually leapfrog. And the second thing is this. The application scenario is here, right? If you just look at transportation, logistics, air, sea, and land connectivity, this is a diverse region, different countries, different ways of modes of transportation. And if you can combine this together, connecting the regions with the right, not just human, but robotics combination, I think this is where the next new amazing companies will be built.
Stephen, over to you with the same question. Single best, where, why, and how are you making it available?
Well, a lot of comments on AI, and I think there's no question AI is going to impact everything we do. And I agree, the opportunity to take great companies and use AI is going to transform. Also the issue of jobs, what do we do with jobs? Because there's no question, you look at things that are customer service oriented, and the AI is so much more efficient. As we look at across all these different opportunities, what we really like is data centers in the U.S. And the one thing that we know is that AI is just going to create this enormous demand for data and this even growing opportunity for cloud computing. So for us, owning data centers for 20, 30, 50 years, we're going to have a limitation on power in the U.S. There's no question over the next 20 years, the technology will change for chips. It'll become more competitive. NVIDIA may not be the only major provider. So I think you're going to have a big technology refresh over the next 20 years. But the one thing we know is you're going to need data centers, you're going to need power, you're going to need cooling to support all this growth in the cloud. So we look at them as long-term bonds.
Interesting. There's no question, everyone, that that some of the shifts that we've seen over the past 4 months in U.S. policy, and let's not forget, it's been only 4 months since the inauguration, have changed conditions in markets around the world and changed conditions for industry and thus created new opportunities while perhaps, I won't say destroying, but weakening perhaps the opportunities that people may have seen previously. Jenny and Marcelo, you both have respective backgrounds in Asia. We've heard a fair bit about Asia from you, Jenny, already, but Marcelo, Latin America. Can you tell us how those shifts, from your point of view, have changed conditions in those respective markets? Why don't we start with you, Marcelo?
So another thing that I do is probably one of the largest investors into Latin America. That's where I'm from. I'm from Bolivia, so I'm passionate about what Latin America can do. And I think that all these new changes in the geopolitical landscape, Latin America should benefit enormously. Mexico sits right next to the United States. And a lot of the manufacturing companies that used to solely manufacture in China are moving at the fastest speed possible to serve the US market from Mexico. What has happened? For the first time in over 50 years, Mexico becomes the largest trading partner to the United States. China is no longer that trading partner. Number two, the world is growing towards the global south. Most of the food that the world will consume, the additional food, is going to come from Brazil. Brazil becomes the feeder to the world. If we believe the world is going to electrify, which I do, most of the critical minerals come from Latin America. Lithium alone, 60% of the world's lithium sits within 3 countries. My home country, Bolivia, which is about 30% of the world's lithium, Argentina, and Chile. Same with copper, same with nickel, etc. So I look at Latin America's opportunities. Feeder to the world as it relates to food, number 1 provider of critical minerals in order for the world to electrify, and the largest trading partner, all supply chain move. The alternate supply chain to China is now Mexico. So now Latin America comes with its complications. So I think the potential, I don't think even if Latin American politicians try to screw this up, they're going to be capable because the forces are greater than them.
Jenny, quickly from you, the good and the bad as a result of these big shifts in U.S. policy that we've seen these past few months.
Yeah, I mean, the first 20 years with globalization, it was about finding that one leader, the ultimate, category leader that can take on the world, and that's where you get premium, right? You get, and large companies has economy of scale, and therefore they are able to then dominate the world. I think with the new world reorder, it means that there will be regional clusters of excellence. There will be regional clusters of great companies. And so it's okay to be number 2, because you could be number 2 in every single region and still command that premium. Because today we talk about AI, we talk about data, we talk about processes that's going to be very specific to industries, specific to countries, specific to regional challenges that needs to be built and addressed. And therefore, the good of it is that now it's not just going for that one company and overpaying for that company until the returns go to 0. It's actually about finding regional champions, which could also be huge category leaders for us as funds. As well. And I think it's actually good for the world to have multiple pots of excellence that can be localized to its own needs.
Stephen, you're in the unique position on this stage and at this conference of having been the U.S. Treasury Secretary. I think it would help us all to understand from your point of view what are global markets misinterpreting or misunderstanding about the intentions and the approach of this second Trump administration?
Well, let me just say, I think there's a lot of similarities between President Trump's economic plan now and what we did in the first administration. And really the three components of that: tax cuts, regulatory relief, and trade. Obviously, there's a lot of activity on the tax bill, the one big beautiful bill going through Congress, which, you know, I think will pass quickly.
Do you?
I do. I think, you know, I think there's some issues that still need to be resolved, but I think that we're on track to see that happen early summer. The second part is regulatory, where we've just seen huge transformations. I mean, if you look at, you know, what's going on in the banking business and all of a sudden opening credit up and other opportunities, I think you're really seeing a transformation in regulation. Now, the big difference is trade. President Trump has always been focused on trade. This is something he's been focused on for 20 years, not just the last 2 terms. And he's determined to create a level playing field of trade. I was very involved in the situation with China. I think there's no question that our markets were open to them. Their markets were not open to us. And if we can open up the China markets to U.S. businesses, there's a huge opportunity. And tariffs play an important part of getting people to the table and negotiate. Now, I'd say the only difference is the president wants to use tariffs to create revenue, and I think he's been pretty clear on that. I've talked about the idea of taking a 10% tariff across the board, scoring that, using that as part of the reconciliation process. That's not going in, but I think the markets have kind of bounced back and kind of have assumed that the president's just deferring all these things and not making big changes. I think we're going to see big changes, and there clearly will be winners and losers along the way as a result of that.
Since you brought it up, I'll ask you a follow-up question on the tax bill. There are 2 groups that need to back down if this big, beautiful bill is going to get passed. On the one hand, it's the SALT camp. It's the congressmen from New York and New Jersey and California who want to see that cap raised. And on the other hand, it's the more conservative representatives who want to see greater spending cuts. For your prediction to hold, for this to pass in the early summer, who's going to back down?
I think it's going to be compromise on both sides. So, you know, you've seen in the press the discussions of the SALT cap going from 10,000 to 30,000. That's both expensive and a pretty meaningful change to people. My guess is it'll end somewhere around that. And, you know, in regards to the spending issues, you know, I'm very concerned about the budget deficit. I think that the budget deficit is a larger concern to me than the trade deficit. So I'm on the side of I hope we do get more spending cuts. Something that's very important. You've seen the Treasury market back up. I think less as a result of this rating change, which I would still rather buy U.S. government securities than any other AAA out there. I still think we're a AAA credit, no matter what the rating agencies say. But I do think you've seen a backup in rates because the Fed is on hold for the moment, and we have big budget deficits to finance.
Ladies and gentlemen, I wish we could continue this conversation, but of course we need to move on here at the Qatar Economic Forum. Please join me in thanking our panelists, Stephen Mnuchin, Jenny Lee, and of course Marcelo Clare.
Please welcome to the stage Omid Malik, President of 1789 Capital, and Donald Trump Jr., Executive Vice President of Development Acquisitions of the Trump Organization and partner at 1789 Capital, for a conversation with Bloomberg's Jumana Brisecci.
Hi. Good morning again, everybody. So our panel is about investing in America. There's lots to talk about. But first, I want to start with President Trump's visit to the Gulf last week. Your brother, also Eric Trump, he was in the region a couple of weeks ago. You're here today.
Yeah.
It's fair to say that the Trumps like the GCC region. What's the draw?
Listen, I think it's amazing to watch. I think if you said 15, 20 years ago that you'd have this level of investment in the Middle East, I think people would have thought you were crazy. I think if you look at the comparison here to what's perhaps going on in Western Europe, this is the place where there's rational investment. People are working hard. You're not dealing with a regulatory climate that's so oppressive that you wouldn't even think so. I think it's an incredible opportunity. And what I saw last week looked truly spectacular. It's an entire reset for the future of Middle East-U.S. relations, the business opportunities. And I think it was just incredible to see. It's truly spectacular.
I mean, we're going to talk about the funds, but I know the primary purpose is obviously to invest in American companies, but you also were traveling with the president, and of course there were many business executives who were traveling around with the president as well. What were some of your impressions of the meetings and the energy that came out of last week?
Yeah, I had the opportunity to be in Riyadh and Doha while the president was here last week, and I mean, simply put, it was historic. To see that reception from these countries, but also the kinds of deals that were made. We've never seen anything like it. And I think most importantly, just maybe from a geopolitical standpoint, it was a reset of relations between the region and the United States, which I think so many of us have been waiting for, particularly when you contrast it to the disastrous policies of George W. Bush in the region, or even the incoherence of the Obama administration. So to have someone come here and approach this from a realist foreign policy, which is what the people voted for, which is a more realist foreign policy and a policy of peace, I think was welcome not only here, but also at the United States, because it's what the voters wanted.
Don, the Trump organization announced several deals as well in the last couple of weeks. Have you found that it's gotten easier to get business done because of perceived access to the White House?
No, I don't think it has anything to do with that. Again, we spoke about it backstage. I spoke, headlined the Dubai Cityscape Conference in 2007. We've had deals in the regions forever. It's something we've looked at, again, prior to most people finding it sort of acceptable to be over here. So I don't think that's changed. I think it's the fact that we've had these relationships for so long that so many of these things have been able to happen. People have talked about that, but the reality is my father was a real estate investor and a builder for 40 years. It's what we've done. And so as the region has developed, as more of these areas have really expanded, especially in the ultra-luxury sector, which was obviously the focus of the Trump organization, those opportunities have abounded. But we've been talking and doing these things both prior to his presidency and during for my brother and I, while he had nothing to do with those things.
Yeah, I mean, critics will say that the U.S. government probably shouldn't be doing deals with entities or government-aligned entities that are also doing business potentially with the Trump organization. What do you think?
We're not, the Trump organization isn't doing business with any government entities. They're doing it with private investors. I mean, many of the people in this room probably know them or have talked about them with that. And so, there is a very clear distinction between those things. In the first term, we actually said we're not going to do any foreign deals, even though that's what we did. Yeah. We had done it for years. We just said, hey, we're going to do this. And the reality is it didn't stop the media from constantly saying, you're profiteering anyway. It was like we stopped entirely. Even the deals that were totally legit, it didn't stop the insanity. So this time around we said, hey, we're going to play by the rules, but we're not going to go so far as to stymie our business forever, lock ourselves in a proverbial padded room, because it almost doesn't matter. They're going to hit you no matter what. So we're just going to play the game.
Let me rephrase the question then. Are there any investments or ventures you would not get into because of conflict of interest?
Yeah, I mean, the Trump organization itself wouldn't be doing direct deals with government entities because that's not what they do and it's not what we have. But that would be it. We're just going to play by those actual rules that are laid out by the government. We're going to play by the rules, and it's as simple as that.
Yeah.
And then on the 1789 side, I think it's very clear. We only invest in the United States in private companies, and we take minority positions. alongside the largest asset managers and most prestigious asset managers in the world. So it's quite simple. And then just if I may step back on the topic more broadly, I find it odd that this becomes a line of questioning, particularly when I look at the previous U.S. presidents we've had, both on the Democratic side, whether it's Bill Clinton or President Obama, who were basically broke when they came into office, have now become magically very rich. So I don't really like presidents that use the presidency as an apprenticeship and become rich later. I think that should be examined more than people who have actually done something in their life prior to coming into politics and then actually take a hit financially. Those are the types of people we should be supporting.
Yeah, I think all of us would agree that nobody in the vicinity or as a close family member should be benefiting from the president's office, position in office. Just on this point also, Amir, both of you started up the executive branch in DC. And again, there's been a lot of controversy around that due to the high membership fees. It's about $500,000 to get access to it. But then again, there's a perception that this is an opportunity for members to get closer to the axis of power.
Anyone who's a member there could get access anyway, so they don't need to go to a club to do that. So that's just a total misnomer. The other thing is that the actual memberships for regular memberships are a lot lower. That's been reported. And in addition, I think this is kind of the theme I want to point out here. What Don and I have been doing before we were invited to be on panels like this, you know, I think only Newsmax was calling us during the Biden administration. Yeah. Not that anyone watches that here, but in any event, we've been doing this for 5 years. When we see a problem as if being censored or deplatformed, as was happening to conservatives in America throughout the Biden administration, we're capitalists. We create other opportunities. That's about as American as apple pie. The executive branch, that club, is another example of that. Frankly, everything in DC kind of stinks. So there were no good options to go and have social interactions with people with our ideological views. And so we wanted to create, again, a solution, which is what we do in every part of the economy through our fund. And we created another option for like-minded people as a refuge away from, respectfully, reporters and Democrats.
Yeah.
Well, I mean, perhaps we should talk more broadly even about the greater conflicts thing. I know for me, I get the, you know, the Don Jr.'s the next Hunter Biden. And I say it's such a false equivalence, right? I've been doing this for a long time. We were businessmen both before. We will be businessmen after my father's presidency. It's what we've done. I didn't become a businessman when my father took office. The difference being we have invested in companies for decades. I saw a problem that was out there. When no one would talk to us, when we were written off the face of the earth in 2020, I still saw the attacks. I started a publishing company, not because I think publishing is the most lucrative industry in the world, but because we had to make sure these voices are heard. I was the second verified user on Rumble. I helped them set up the pipe that enabled them to go public because the other social media platforms were canceling us. When Twitter threw my father off, we started Truth Social. So we created actual businesses as a solution to the problems that were being thrown at us. We got into cryptocurrency. That's another one I read about, a lot of conflict these days. We got into cryptocurrency because we were debanked. And so it's interesting. I mean, there's many people in this room that in the past I could have called at any time in my life, hey, I need a loan to build a building, because that's what we did. And I would have gotten a call back and a loan in about 5 minutes. All of a sudden, those people wouldn't take your calls. They wouldn't have your bank accounts. And so we did and invested in businesses as solutions. Yeah. The corollary to that is Hunter Biden, who magically became a businessman when his father took office. He was paid by shady foreign companies to peddle influence and influence American policy. And that's not what we're doing.
So let me just ask you a question before we move to 1789. But I do want to ask you, since you bring this up, free speech, do you still feel that you're censored? Because you're pretty outspoken. You say
I think
whatever you want.
I think Elon buying X was a major game changer, but we were censored across the board. By the way, I was on Fox News every day of every week for 5 years, and in the early 2020, after the election, I wasn't on for 2.5 years. So it wasn't even just the liberal-dominated media or social media platforms. We were just off. So again, we created our own solutions. We fought back. Elon buying X changed the game, because it didn't become a conservative platform. Liberals just weren't comfortable with anyone being able to fight back. They were so used to anyone putting up a credible argument to them just being shadow banned, just being censored. We've seen that with our own eyes. So we created solutions to all of these things. they're not conflicts. They're a reaction to the market and to the, frankly, the landscape that was presented to us because, as I've said, we've always been business people who are coming up with those. We're innovators.
I mean, let me ask you about 1789. I believe you've got about $1 billion assets under management. According to the conversations we've had in the back, I understand that the fund will only invest in industries that are aligned with MAGA philosophy. So what is in the portfolio right now?
Well, by MAGA, we mean Make America Grow Again, and that's kind of our thesis, and it comes within this paradigm that we've defined as entrepreneurship, innovation, and growth, which is our own acronym, which we find is a contrast to ESG. The notion that we observed is twofold. One, that the largest companies in the United States had become effectively monopolistic and were suppressing, in many cases, through a backdoor route, constitutional protections. He's talked a lot about the First Amendment. It's a reason why we've made investments in media. You saw the role that independent podcasts played in the election. The landscape is changing dramatically because people are hungry for that type of information. We invested in Tucker Carlson's new company. We invested in Substack, which is a free speech platform on the digital media side, trying to enhance the First Amendment in the United States through the private sector. And then, of course, we won't stop there. We believe the Second Amendment is also very important. Later this month, Don and I and our team will be taking a digital retailer called Grab a Gun public, where you can buy guns and ammunition online just like you can on Amazon, because we have a Second Amendment right. But again, that's an entire area that's been starved of funding in the United States for ideological purposes. And by the way, it's not just about whether we think it's good or bad. I think it's destructive for shareholders. If you look at a study of public benefit corporations, which are companies that behave the way that ESG overlords would love them to behave, since they've gone public, they're down about 80%. So, you can say what you want, but if you're a capitalist, you shouldn't lose money. And by the way, if they want to lose money and do ESG, we're okay with that. Go ahead and do that. But we're going to provide the other half of the country, or probably 75% of the country, an alternative. And that's really the genesis of why we exist. We have now expanded that into, in our opinion, investing in the best disruptive technologies in the United States. And so our basic KPIs is we're looking for TAMs of over $10 billion, companies that are growing over 25%, and we're looking for a liquidity event in 2 to 4 years with 200 to 300% returns.
Isn't there an argument that what was the parallel economy is now becoming mainstream because of the change in thinking?
But someone had to actually do that. Right. It was very unpopular to do these things. We took another company public during the last 4 years called Public Square. An alternative marketplace to the places that were taking advantage of Americans. So many Americans, and it was sort of interesting, we did these things because half the country was being left by the wayside. Half the country was literally concerned about being debanked. They couldn't get insurance. They couldn't do so many things. And everyone pretended like it wasn't happening because they're in their spheres of New York and LA and Washington, D.C. They didn't realize what was going on with an entire base of probably about 150, 175 million Americans that legitimately had these concerns. They were flagged by the FBI as being extremists or being terrorists because they bought MAGA apparel or a Bible. This stuff was actually going on in the United States. And so it was an entire segment, half the country, that no one would even cater to. So Omid and I had been discussing this for years, since 2020, and he said someone has to cater to that. That was a big risk. That wasn't that easy because, again, of all the problems that went around that. But what's nice about us is because we took that risk, because we gave those people that platform that they so desperately needed and felt they weren't getting, I think we probably have the most credibility of anyone in the world to do this because we were the ones that had the guts and were willing to put our names, our money on the line to make sure that these people had a chance.
The 1789 is the year the Bill of Rights was introduced in the United States. So, it's very much part of the ethos.
So let me come back to that credibility point. Moody's just downgraded U.S. sovereign rating on Friday. The dollar is down 7% this year. Lots of external investors are questioning whether some of the decisions made by the Trump administration, be it on trade, on putting America first, are actually going to be beneficial for the U.S. economy. Is MAGA working for the U.S. economy?
I think without question. I think if you look at what happened in the last 10 days, trillions of dollars of investment. I think the problem that we have is these days, and with the media bias and hysteria, so many people expect you do something and it's instant gratification. You get whatever you want right away. You know, the reality is that's not how the world works. These things take time to foment, to build up. You have to actually wait a little bit for these policies. You saw it when the S&P dropped in a week, and there's, oh my God, it's the Trump crash. Everyone's lost their entire 401k. What did it take? It took 10 days to get back to where it was, and now it's ahead. You know, it's nonsense. It's hysteria driven by the media. No one who's ever done business, gets that instant return in 1 week, but they expect people to believe it. When the market goes down, it's the Trump crash. When it comes back up, Trump gets no credit for any of it, right? It's someone else. It's these other factors that did it. We've seen this story play out so many times, and I think it's why we're investing in independent media, because I think the mainstream media has frankly shot so much of its credibility by doing this. Everything's about clicks and hysteria, and if it's bad, Trump did it. If it's good, it's everyone else. It doesn't work that way. I think if you give these things time, if you let this investment take hold, this is game-changing for America, for the region, and for security in the world. And if you've been watching the world, I think everyone recognizes that a strong America is not just good for America, it's good for the world. Yeah. We've seen what happens for the last 4 years under weak leadership, and perhaps we needed that weakness for a while. We needed to hit rock bottom to understand just how fragile all of these things are, just how quickly our democracy, our freedom, the peace we've experienced under my father's first term can go away. We went from a time of prosperity to a time of poverty. We went from a time of peace to a time of war. And now, again, it's been, 8-9 weeks? Yeah. And we're already back at the table when the other administration wouldn't even have these things. So we can't be in a mindset. I see everyone nodding, so I think they agree. We can't be in a mindset that you do something, and the next day, the stock market's supposed to go up 12,000 points, and everyone's happy. These things take time, and people have to acknowledge that.
I'll just say one thing about Bidenomics.
No,
so you said MAGA, but Bidenomics gave us 20% inflation, okay, right? That's what you had there with Bidenomics, is 20% inflation, stagnant wages. That's what we inherited. So when you're talking about imposing a new order as far as the economy goes, we've already talked about resetting the international system, the failure of wars that broke out all over the world under Biden. So that's step one. As far as with the economy, you can't be myopic about it. Tariffs are only one aspect of the overall economic agenda. It's a necessary one and it's a tool, but you have to put that within the context of energy production in the United States that's going to finally be unleashed, closing the border so you don't have an illegal alien invasion, which then depresses wages. You also have to have tax cuts and a deregulatory environment. When you put all of that together, that is the MAGA economy, and that is how we're going to grow in a way that we haven't in decades.
Yeah, so that's the overall thesis. And just to go back to what we were saying, we didn't really hit rock bottom. We had financial volatility, and of course markets have recovered.
Well, I'd say but endless wars, millions of people dying for no reason, incompetence. 100,000 Americans die a year from fentanyl traffic over a border that was clearly opened for a demographic shift purposes. Okay, that's not a conspiracy theory anymore. We saw that 100,000 Americans. Just so we're clear, that's two Vietnams a year in America, and no one was even talking about it. There was a morality crisis. There was clearly with the inflation and everything else going on. The only people that benefited, frankly, for the last 4 years was big war, and that's a very powerful lobby in Washington D.C. There's no money in peace. And so I think someone said it the other day, if my father's one legacy is to be the president who created peace in the world, I think that would be his #1 legacy. And it's quite ironic that he's the only guy actually trying to achieve that when the soundbite for the last 9 years has been he's going to be the guy to start World War III.
Let me ask you about one of the other objectives, which is to bring manufacturing jobs back to the U.S. because there's a view out there that many of those jobs have been taken by Chinese workers. But at the same time, a lot of these jobs are low-skilled jobs. And the reason that it's been difficult to employ people in these spaces is because of low-cost needs and also because of the rise of automation. It's not going to be so easy to recreate all of those manufacturing jobs again, will it?
No, it's not. And I think this general thesis that we're going to be making the little plastic figurine that goes in a McDonald's Happy Meal that's going to be manufactured in America. That's not what we're trying to do. We understand we don't have the workforce. We don't have, it wouldn't make sense. But I do think we have to be investing in American semiconductors and making microchips and taking care of our pharmaceutical needs rather than being dependent. 93% of our pharmaceutical needs come from China. Well, we saw during the pandemic that the second they didn't like some of the sound bites, which now all happen to be very true, but we were told by China and the World Health Organization at the time that they were conspiracy theories, that it started in Wuhan, et cetera. They stopped sending over the ships with the protective equipment, the PPE. So we can't be reliant on those who have proven that they're clearly not our allies. They're adversaries at best. And so we have to make sure, and by the way, that's not just going to happen in America, but we can't be dependent on one nation. If this gets spread out to a whole lot of other countries who have these same mutually beneficial deals with the United States, that's good for the world, and we need that. That's good for everyone else to be able to have alternatives to China, because I don't think they're going to be a long-term good actor on the world stage, as evidenced by almost literally everything they do on a daily basis.
A country that does not control its supply chain has no national sovereignty. This is not about some pie-in-the-sky idea or nostalgia. It's a national security issue. And President Trump was the first president to make that at the forefront. You simply cannot have a country that has 4 times your population and employs slave labor to produce everything for you. And by the way, we had no reciprocity in the relationship. So Secretary Mnuchin was starting to talk about in the previous panel, but it goes to every aspect of it. The notion that we have to have a local partner to do business there, yet they have complete unadulterated access to our markets. Even when they list companies on our exchanges, they don't have shares, they have ADRs, which means that our shareholders actually have no legal recourse against them. We can't list any companies over there. I mean, it goes on and on. So again, this is just common sense, and yet people want to say that, oh, we're doing something that's bizarre. No, we're trying to bring back a United States that is strong and prosperous. And again, 1789 is investing in the reindustrialization of the United States in order to help foster that on the private side.
I mean, what do you make of the decision out of the Trump administration in the run-up to the trip to the Gulf last week to loosen those restrictions around chip technology? Because some critics within the U.S., the more hawkish voices within the administration, are saying that this could pose a national security threat because it's unclear whether that chip technology will eventually be passed on to China. What's your assessment?
Well, so exactly what those hawkish voices don't understand the irony of their position. So if you come to this region and you do not do business with these countries that are some of our best allies in the world that are hungry to partner with the United States, you are therefore then pushing them into the hands of China. So it's a totally counterproductive position to have. We know that these are partners that want to go towards the West, the United States. Look, the future is in the Gulf, and you can see that the United States and President Trump recognize that this is a region that we want to double down on as far as a partnership goes, saying, no, we're not going to do business with you because we don't trust you. Well, that's a great way to enhance Huawei and the Chinese. So I think that's why it was such a smart move for us to partner with our allies here, and that's actually going to continue American dominance.
Don, do you think the U.S. fiscal situation is going to derail the willingness of people to invest in the U.S. because of this, there's concerns, serious concerns about the size of the deficit, the size of the debt overhang?
Well, listen, I think the way to handle the deficit, and I think, again, a lot of that was added in the last few years. I mean, it's why you had the inflationary measures. But if you saw the inflation numbers that came out last week, hey, wow, they're back to normal. Because it's amazing what someone who's actually conducted business, being in charge of the world's largest economy, what that can do, right? You see what's happening right now. Again, these things do take time to happen, but I actually don't think that people are concerned about investing in the United States right now, especially under this administration. I do see those concerns the last time around because you had undue regulatory environment. You had individual companies being attacked because they weren't politically aligned. It was basically an extortion racket. You saw that. We dealt with that in New York all the time, even with the Trump organization, where we're getting sued for paying back loans on time with interest, where the alleged victim is testifying on the stand that, no, we had a great relationship. We want to do more business with Trump, not less. So we're trying to create an egalitarian environment where everyone has a chance to succeed and create a regulatory framework that makes sense for these companies to come into the United States. That wasn't apparent for the last few years because no one knew what was there.
So the tax cut bill that's potentially going to be passed could add anything between $2.5 trillion to $5 trillion to US debt over the next decade. Is it worth it?
Listen, it's going to work because of the growth that's coming in there. Again, you've seen in 10 days the amount of investment that's coming into the United States. That's going to trickle down through all of the people. And that's not just for the benefit of the rich, bringing back certain manufacturing and elite manufacturing so that we actually have highly trained people in those businesses. That's going to be incredibly important for the middle class. And that's what my father's done this for, right? I promise you. It was far easier being a real estate developer from New York City. I used to be invited to all the cool person parties. We didn't have these things. He got into this game because he was sick of seeing what happened to the people that he knew, loved, and learned from, because he wasn't your typical New York City billionaire. He was good as a developer because he spent time on the ground with real people, the construction workers. He listens to their opinions. He heard what was happening. He knew it, and he heard it for years, and he got sick of it. He's been talking about it very consistently since the mid-'80s when he was on Oprah talking about it. At that point in time, it was Japan who was taking advantage of us on trade. So he's been doing it for those people, and I think those people are going to see the incredible benefit all of this. What was happening right now was, in the past 4 years, was not working.
Yeah.
It was a problem.
Final question for you. MAGA ideology is dominating the Republican Party now.
Yeah.
After President Trump steps down, would you consider picking up the reins? Would you run for office?
Here we go. Well, oh boy. Well, it's an honor to be asked and an honor to see that some people are okay with it.
Those are just our friends
Yeah,
in the front
that's
row,
probably
by the
just
way,
a couple people
like
we know.
the team,
those
that's
are
like
the
three
tickets
people
we got.
yeah, that's it. Right.
You never know. Right now, this has been my focus. I think it's not just about government. It's also about the business sector doing that. I think when we saw, again, the woke ideology that has taken over corporate America for the last decade or so, being on the forefront of combating that insanity, I think is fundamentally important. I think those two things have to go hand in hand. So the answer is, I don't know. Maybe one day, that calling is there. I'll always be very active in terms of being a vocal proponent of these things. I think my father has truly changed, the Republican Party. I think it's the America First Party now, the MAGA Party, however you want to look at it. But I think more importantly, again, over the last 4 years, I don't mean to keep harping on that, the things we went through, the lawfare, the nonsense, the jailing of our constituents for peaceful protests, it was insane. And what it did was it created an environment where you no longer have these milquetoast Republicans dominating the Republican field. Certain people, and a good handful of them, stepped up. They fought back. They made a name for themselves fighting the insanity. And now they have a following. So for the first time ever, the Republican Party actually has a bench of America First fighters who are willing to do this. Not another Mitt Romney, great, he'll come in, he'll be swayed. People who have the conviction to actually fight for what they believe. People who have the resolve to actually do what they tell their constituents when they're in a room with them and it's private. Right now, we've seen too many people, they'll sit there, they'll tell them everything they want to hear in a nice room, and then they go back to D.C., the Washington Post is going to do a hit piece on me. I'm going to change the entire ethos of everything I've told my people and capitulate. That is no longer. I've said it so many times. In 2020, all the Democrats had to do was be quiet. Okay, Trump would have won the election. I think everyone probably believes he actually won at this point. Anyway, I don't think anyone
that's
with
for
a
another
sentient brain
discussion.
actually believes that. That's another session. But all they had to do was let it go. Trump would have had a cabinet that wasn't always working for him. There were some people that were great and some people that weren't. Now, over the last 4 years, we have a team of tested warriors who believe in him. We know who those people are. They're fighting for him. They're aligned. And these next 4 years can be so much more productive. Had that not happened, again, you would have had a sort of very average cabinet. They would have slowed him down. They would have slow-rolled it. You'd probably have a Democrat president right now. I think this is the greatest opportunity. These next 3.5 years is the greatest opportunity to reset America, to reset relations around the world, to create prosperity and growth for everyone. And I'm all here for it. I'm super excited about it.
So I guess the answer to my question is maybe.
Maybe. You never know.
Donald Trump Jr., Amit Malik, thank you so much.
Thank you.
one day smart money is going to come into this business.
There's not just financial assets, but there's a whole asset class now that's really emerged through the development of the Premier League. Today, I think that any rights owner, rights buyer has to put women in sport at the heart of what they do.
If you look at the sports ecosystem broadly, it's $3 trillion.
Families pass on fandom generation to generation. You don't see that in any other consumer product.
Please welcome to the stage Mark Atanasio, co-founder of Crescent Capital and chairman and principal owner of the Milwaukee Brewers. Ted Leonsis, founder, chairman, managing partner, and CEO of Monumental Sports and Entertainment. And Amanda Stavely, CEO of PCP Capital Partners, for a conversation with Bloomberg's Jason Kelly.
Okay, this is what we call in our business a hard pivot. We're going to go from talking about investing in America to investing in sports. So I'm really happy to have the three of you with me. We want to get you guys involved in this conversation. So I want to put up a poll about investing in sports. If we could show that, and you guys can weigh in on this, and I'm going to have the panelists weigh in as well. And it's all about where you would invest. If you could invest in any sport right now, what would it be? And just to clarify for the audience, when we say football, we are outside of America, so we're talking about the sort of football that Mark and Amanda are invested in, also known as soccer. So take a look at that. I want to start by asking each of you not just where you would invest, but let's talk about how much it costs to be in sport right now. It's really expensive. All of you have gotten in at lower levels, but Amanda, I want to start with you. Valuations, if you had to distill it down, how do they feel right now across the sport ecosystem?
Well, valuations are toppy at the moment. I mean, especially in football, in my opinion. I mean, we invested very well. We first went into Newcastle United. We were investing at under 2 times revenues. There is a big still dislocation between the European markets and the US market. So I think football has continued to be, you know, it's a prized asset, so there are fewer teams. So valuations have risen and continue to do so.
So, but feeling a little, so toppy, and if I'm translating that for the American audience, that means expensive.
Expensive, I would say, yeah.
Mark, do you agree with that?
Well, sure, especially because no one in sports really looks at cash flow or losses. They look at multiples of revenues.
Right.
So almost all of these teams actually lose money, even at the enormous valuations you see in the NBA. Cricket, you know, is on something we're looking at now, already being in baseball, football, and golf. Cricket clubs in the IPL in India are trading at 10 times, 12 times revenues.
Yeah.
In something that's emerging.
And so, Ted, what effect does that have on people coming in? You got in a long time ago. You know, you own a hockey team, a couple basketball teams, an esports team there in Washington, D.C. Are the prices high enough that people are sort of holding off, or are there always going to be buyers who are willing to pay up and up and up?
I don't think you can have a blanket statement, but I think we're terribly undervalued right now. It's the only category in media and technology that has kind of built-in annual growth. And if you're in a good market, I mean, we're in top 5 market, most important city in the world in Washington, D.C., but our media market goes Virginia, Maryland, 10 million households, very educated. It's an important business in that community. We're not just in the team business. We own real estate. I now have 1.6 million square feet. I can walk to the White House. I can walk to the Capitol. President of the United States decided to have the inaugural in our building. We were called the most important arena on the planet. And so I think the multiples by leagues are maybe a little frothy, but not on control changes.
Okay.
If you want to buy one of these teams, they are the jewel. No competition. Government allows you to be the only team in that region. And I think that the tree can still grow to heaven.
And so, Amanda, how does all of this inform what you look at next when you're thinking about sports investment? I mean, it's been public that you were part of the Newcastle ownership. You're potentially looking at another football club. How do you go about assessing it, and what are some of the metrics you look at to determine what is a good deal here?
Well, as Ted said, great clubs, story clubs will always attract a lot of, interest in investors. So there's a scarcity value. But what we look at is opportunity to grow that market. Most especially with the clubs that we're looking at, one of the difficulties is the new regulatory environment, and the cash flow is key. So in the UK, you have much more stringent financial controls, profit sustainability. So we're looking for an opportunity to invest where there's that arbitrage to get things, right. So I can appreciate that, there are some assets that are,
right.
A lot of the clubs in the top of the Premier League, they change hands very rarely, and that's not always the same in the US. So I think we're looking for great opportunities in football at the moment.
Yeah. I want to hear what the audience had to say about this, but before we get to that, Mark, I mean, on that point that Amanda just made, part of your thesis in going into Norwich City in English football was that sort of, here we have it.
And the answer is?
And the answer is, okay. Oh, so this is soccer dominates global revenue from, okay, we're going to talk about women's sports in a second. And here we go. All right, which sport are you invest? Okay, so they're with you, Amanda. Football. I mean, not shocking, but you did it. So tell us
Sure.
why.
Well, it started because we felt with 20 years of experience in Milwaukee, along with operating management and 40 plus data scientists and analytics people, we could maybe bring some of that expertise to a sport where it's really been more about star power with players and coaches. Mm-hmm. We looked a lot at the impact you have in the community, which Ted and Amanda were talking about. Norwich City is at the east of England. It's a few 100,000 people, more churches than weekends, and yet when they put out a mental health video which is, I encourage everyone to watch, 2 minutes, globally within 2-3 weeks, 60 million views, 60 million. So the impact you can have globally in football exceeds the other sports, and that's really what attracted us.
So I want to talk about, some of the folks who are investing here, and all of you have had some experience with this, either in your non-sporting life or in your sporting life, which is institutional capital coming into sports. Ted, we're notably here in Qatar, which is a partner of yours, and that was a historic deal when the QIA, I believe, came in to Monumental as a minority investor. I want to start with you. What has been the effect, in your opinion, of having institutional capital come more aggressively into team ownership?
Well, when private equity started to come into the market, it frightened me because I have a private equity fund, and while I'm a large limited partner myself in the fund, you're investing other people's money, and you want some kind of exit.
Right.
And these are not the kinds of assets that are transactional. These are, the Capitals, this is our 50th anniversary. The NHL is over 100 years old. Our building, we're transforming it right now, it's 30 years old. They have longevity. Their connectivity in the market and in the community really is important. And so when I set out to find a partner, I fell in love with the people here, mostly because their view of the world was very synergistic with me and my family and my partners, which is Washington, D.C. is a very, very safe harbor to make investments in. The real estate market is going to be very, very strong, and we should continue to look at this as a long-term play. You can't look at it in 5-year horizons. I've owned the teams now for 25 years, and I paid $85 million for the Washington Capitals. Maybe they're worth $2.5 billion now. I paid $350 million for the Wizards, maybe $4.5 billion now. But that doesn't matter because they're not for sale.
Right.
What we want to do is to build long-term, and our business model looks like a SaaS business. I grew up in the tech industry. We were the first internet company to go public in America Online, and subscriptions and revenues that can be rejuvenated year over year. About 80% of our revenue is contracted. Our variable ticket sales, season tickets, they renew in a bad year at 80%. In a great year, 95, 96%. And so it's the safest kind of investment. We grow 5, 6, 7% per year. It's like a coupon. And as long as you don't do anything crazy and stupid, break the CBA, go into the tax. So if you're good partners, I thought sovereign wealth funds would be the right next generation partner for sports teams. We had to help to rewrite the charters of the leagues to allow pension funds and sovereign wealth funds to come in. And they've been our best partner. They're helpful when needed. They're very passive when you don't ask for help. And this would be a great investment for them. I take that responsibility very, very seriously. And sports, entertainment, technology, you know, what I saw last night about the museum, dramatic. I mean, that's what we're building in Washington, D.C. I just built an art gallery right next to the arena. We're going to have a museum within the arena. These people get it. Education, universities, Georgetown plays in our building, NCAA plays in our building. As I said, the president held the inaugural in our building. These are the modern day conveners. And so we've built a platform where we control the IP, the teams, the platform of distribution, both through linear and digital. We own our network without any debt. We're the only regional sports network that has no debt. I heard a lot the last 2 days about debt. I'm a poor kid. I hate debt. And so these are good businesses still in the distribution side. And to be able to build a platform, multiple teams, all on one platform, I think is the right strategy.
Yeah. And so, Amanda, what is the effect in the near and midterm of this institutional capital coming in? You have direct experience with this. Does it impact valuations? Does it impact who grows faster? Like, play this out for us as you think about this new source of capital.
Well, I mean, I agree with what Ted said. I think sovereign wealth funds make great partners, and because they're much more used to long-dated assets and sport is, you know, comfortable with partnerships that go on for 10, 15 years. I also think that institutional sovereign wealth fund capital has made the way we invest much more efficient in terms of we've been able to introduce regulatory rules which have attracted more private equity style capital because, you know, you have to be efficient. So I think that the more and more we get, the more traction you get sovereign wealth funds into this environment, you're going to grow the valuation pool, and good assets will always grow. I think what Ted has done and what Mark's also doing is important. We need to not be complacent. We need to make sure that we create the best type of, whether that's football or golf or whatever our speciality is. We need to make sure that when we look at what we're producing to the fans, we provide. You've got the right infrastructure. Infrastructure around sports venues is key. And Ted talks about having no debt in his content business. Again, debt is expensive. Cost of capital is going to, especially at this time, the cost of building a new stadium, a new arena it's a lot of money. So if we
Ted knows all about that.
We just did a partnership with our city where we're redoing our arena and the real estate around it. And the city's putting in $515 million.
Yeah.
And it's been a great partner for us. And we've put in 200 already. We'll put in another 300. It's $1 billion new front door for downtown DC. And we'll be responsible for basically rejuvenating downtown.
And so Mark, Amanda mentioned golf, and golf was among the things people are investing in. You're part of Strategic Sports Group, a number of very successful team owners who have come in to sort of accelerate some of the things that are happening in golf. What happens next with golf? This is a sport that is very closely watched and invested in this region. What can we expect to see, and what's happening in the world of golf?
Well, interestingly, we talk about this story to these sports. Golf was probably founded in the 15th century, and King James in 1457 stopped the men from playing golf because they were playing golf and not doing archery, which was a military situation for the country. And so you've got something that's 600 plus years old, and that everybody plays everywhere in the world, whether you're 5 or frankly 85. We saw an opportunity, really John Henry at Fenway Sports Group, and the leads in that are he and Steve Cohn of the Mets and Arthur Blank of the Falcons, to the PGA. Actually, I think in a way people talk a lot about LIV. LIV was a really good catalyst for bringing golf into this proper today's generation and today's sensibility. So the PGA realized that it was somewhat sleepy and looked to bring in us as partners to really align interests with the players. Everything starts with the players in these sports, and then second with the communities. So our group of owners have helped manage the PGA. And whether that's, everything is up, by the way, starting with social media.
Right.
So both social media in baseball and golf probably was behind, those sports were somewhat sleepy. In golf this year, we're up 60% in terms of social media metrics. We're up 10% in attendance in tournaments, and we've sold $450 million of new sponsorships in the last 6 months. So, we're helping the professionalization of the sport, and I think that LIV occasioned that because everything was sort of just, complacency and was the order of the day. The future, I think we're hoping to align interests. You're dealing with 2 governments now. You're dealing with 2 groups of players, and you're dealing with fans and, by the way, players who want to see the best compete against the best. So we're hoping to be a catalyst to facilitate that.
And Amanda, we're getting a little short on time, so I want to make sure we touch on one thing that we saw a chart about earlier, which is women's sports. The whole ecosystem is growing. We see a lot about that in the United States. More recently, back in England, we saw the deal with Alexis Ohanian coming in to the women's side at Chelsea. Where are we in that evolution, and what is the opportunity? How do you sort of suss out the growth opportunity? How would you characterize it in women's sports at this moment?
I think the Chelsea deal was extraordinary. I mean, incredible valuation and great on Chelsea because, the first deal that happened, I think they did an internal deal, and now it really does underpin a valuation that will support a lot of clubs in the Premier League, especially in women's sport and women's football. Women's football, I always say, let's not be complacent. we have to attract more audiences, and we have to ensure that we get our fans to go to women's games, that it's supported not at the executive level, that it's not just done through corporate deals, that we actually get the broadcasters and we make sure that we drive everything towards the women's football game.
Right.
And I'd say women's sports is the growth stock right now. We own a WNBA team with a second most tenured ownership group in the WNBA, and what's happening there is indescribable. Sellouts, media deals, long-term commitments from sponsors, being able to sell suites, and opening up a whole new category of advertisers, endemic to fashion and for women. And so I think that, you know, I'd like to make Washington, D.C. the women's sports capital of the world. Essentially, Title IX is what changed everything for the United States. And, you know, we have a great women's soccer team in D.C.
I was going to say, Michelle Kang very much agrees with you with that sentiment, I would imagine.
Yes, but she's a little bit off strategy, because my belief is that a platform has to be regional and geographic.
She's going global.
Yeah, and
she's global.
So I don't want to acquire a soccer team in London, which always, it's like 20 teams within 50 miles.
Okay.
Like,
yes, there are a lot.
That wouldn't happen in the NBA and the NHL and the WNBA. But I do think that women's sports is just getting started, and there being the multiple right now is the same as the NBA, 10 to 12 times. But the revenue growth is
But you have, in basketball, you have the support, you have the media rights to support that. And I think there's a slight dislocation with the UK in that we don't have that yet. And I think there needs to be, you know, you guys have got it right.
I also think the way the leagues are structured, right? So the NBA, the NHL, we look at ourselves like we do in DC as a platform.
Yeah.
And so we've got NBA Africa, we've got NBA China, we obviously have been announcing work that we're going to do in NBA in Europe.
Right.
We'll have some expansion in North America. All of a sudden, we will look like a Google, will look like an Amazon, right? Where all of their growth started the first 10, 15 years in North America. But of the 9 billion people on the planet, there's 350 million in North America. You've got to go. So the pivot from analog to digital, North America to global, bringing in very savvy investors with a global mindset, I think augurs really, really well for these leagues.
So many more questions for you guys, and encourage you and the audience to find these guys outside if you can. So much going on in sports. Mark, Ted, Amanda, thank you so much for your time. Really appreciate it. Thank you all.
Please welcome to the stage Marcus Kreber, CEO of RWE AG, and Julian De Breda, President and CEO of Fluence Energy, for a conversation with Bloomberg's Francine Lacroix.
Hello, everyone, gentlemen. Thank you so much for being here. We have 20 minutes to redo the energy complex and try and figure out, first of all, how much energy we need and how much more because of some of these AI centers. Marcus, let's start with you. When you look at the global energy transition, what do you see as the current state of play for AI and data centers? And again, how much energy will it use? I mean, sometimes I look at the numbers and I have to read it 3 times because they're so massive.
So being in energy and especially in power, electricity, it's a great outlook. We know that there's more demand for our product through the electrification, but especially through the AI and data center boom. But on the other hand, you also know and realize that we are probably the facilitator, but currently also the bottleneck. I mean, how fast we actually see deployment of new data centers, and we need to overcome these hurdles.
Julian, how much more do we need to build from what we have now?
I mean, the view, there are two things that are, it's a huge change for our industry. Let's start with that. For the last 10 years in the developed world, investments in power have been essentially replacing technology. So there was no real hurry. You know, a coal plant was closed and a lignite plant was closed, and then you were put in a new plant. Now our job is, accelerated investment, so jobs, taxes. So it opens a completely different world for us. We now live with an urgency that's tremendous. The idea is that, not only that, it's also a race. AI is a race. Whoever gets there first will win. We've seen that in most of the information technology business. It's a winner takes it all. So we need to help our economies win that race, and we need to move as fast as we can to be able to deliver that. That's the second one. And the third one, connected to this, is that I think, and this will come from clearly conflict, my own opinion, but that there's no way of meeting the needs of the power of the AI revolution without renewables. There's no way. We will need gas, we will need nuclear, we'll need, all this stuff. But there's no way. Renewables will play a fundamental role in that process. And we need to get ready for it.
And Marcus, will that be accelerated? I mean, again, to Julian's point, this has to be at speed. This needs, an enormous amount of capital being deployed. So what's the hardest part of what you're trying to achieve right now?
If you look at the individual pieces, it's not so problematic, but getting all ducks in a row, because it needs a lot of things to bring more power to the market. It all starts with permitting and planning. And that was actually across the globe, also in the US, but especially also in Europe. It was always slow because of the reason Julian explained. It was only replacing existing capacity, but now we need to build additionally more. Second is supply chain. And especially global supply chain in an environment where you have geopolitical tensions and discussion about tariffs make huge investments more complicated. You need to get your head around that. And then, of course, the infrastructure, so upgrades on the grid, and then additional generation technology. And I'm with Julian, it needs to be an all-of-the-above strategy. We should do our research on fusion for maybe in the next generation. Nuclear remains to be seen, but very long timeline. We definitely need wind, solar, and battery solutions. And a good message, especially for Qatar, a lot of gas will be needed for much longer.
So if we focus on RV, I think your power generation has been declining since 2021, right? Now, because of AI, how much are you expecting to increase it by? And in what time frame?
So what I see, we operate in the US and in the European Union and UK. What I see is the US is much faster and ahead of the curve. We expect power demand to grow by 3 to 5% per annum, depending on the different regions. Europe will pick up a bit later and slower, but from all the discussions we have to also make our infrastructure available to facilitate new data centers, it's going to come. Maybe not at the same pace, but it will come, and I expect breakthrough, as you have also seen with the first announcement yesterday in France. I expect the same for my home country, Germany, UK, more to come, but maybe 2 years later.
Julian, are politicians having, first of all, the right conversations? Because, again, a year ago, everyone was saying, look, this is something that we need to fix amounts, but it was never #1 priority for government. So, first of all, has the language, has the immediacy of it actually changed?
I think the challenge we have today, I think that there are different things, but I will call you, I think the main change, if you ask me, what I think will make a big difference is at the regulatory level. Right. As we were for 10 years, just replacing technology, regulators got used to this idea that you could take time. A project could wait a year. At the end of the day, the electrons were not going to be, the electrons that come out of a coal plant are not any different than the electrons that come out of a gas plant. They're not any different. But now that those electrons are feeding businesses, jobs, taxes, schools, opportunities, well-being, speed is essential. we cannot wait 2 years for an interconnection. It needs to happen. So if you ask me, that's where we need to see the change. I think from the government side, generally there's a recognition that power will play an important role. I think from the markets, the financial markets are very supportive, so we haven't had an issue. That is where the trick needs to go. And the second point that I think we need to be, where we need to probably make a change, is that I think we need to be agnostics about what's the solution that best meets each of our needs. So all of the above, to ensure that we actually can do things at the speed we need to do them. Because there are a lot of solutions that sound very good, that will play a significant role, but that will take 4 years. 4 years from now, you won't be able to catch up with the Chinese AI. You won't be able. If you have to wait for that, it won't happen.
But
I would like to add one thing what has also changed. I think politicians have not only realized that it's about speed, it's also about safety and security, because it is critical infrastructure, the power infrastructure as well as the data infrastructure. And we need to find the right balance between speed and protecting your data, but also protecting your critical infrastructure. And especially from recent events, we have seen the big blackout on the Iberian island, but also the messages from the US, what they found in certain devices out of Asia. That will play a very relevant role, how we set up this entire energy and data infrastructure.
I know Julian says you have to be agnostic, but actually how much does security and price come into play? Because maybe the two are at odds instead of working hand in hand.
I think you have two aspects of that question. One is your infrastructure safe, and do you control it? It's a critical infrastructure, and if it breaks down, it has severe impacts on lives, on society. And the other, but that is only true for certain regions, definitely not the US, not the GCC region, but it's relevant for many parts of Europe, for Japan, Korea, where many of the energy currently needs to be imported. And of course, how do you create a diversified energy import landscape, but also where can you actually reach more independence? And there, of course, nuclear and renewables are one way to get more independence.
I completely agree on the cybersecurity, and I will add, completely agree. That's the other point that we need to diversify the supply chain of our industry. We cannot have a supply chain that's dependent on one country. Not because, any country is good or bad, but, just bad policy. So I think it's very, very important that we work on bringing that supply chain to, diversified. It also, we clearly want competition, we want lower prices, we want all of that, but we cannot be dependent upon one country only. It doesn't work.
I was going to ask you actually about supply chains, given all of the turmoil and tariffs and trade wars. Like if you look at the energy complex, for example, how many battery cells comes from China, and how much will that change because of Trump policy?
Today, it's interesting, batteries, because the patents for batteries, so all the basic research for batteries were done in the US and Japan. None of it came out of China. In the 1950s and then over time, up to today, the LFP batteries, which are the most common batteries, were developed in MIT. Yeah. But right now, what happens, all the supply chain is in China. And that, I think, it's nothing against Chinese. I think the Chinese have brought this industry and have continued to provide lower prices, and they have done a great job. But we cannot depend on one country, and that I think is a concern. No?
But apart from batteries, what other components?
Oh, the batteries are essentially Chinese. I think the other ones where we see a major concern. I think I would say batteries is the one where we have the highest concentration. Then I think it will be solar panels will be the second one. Wind is it's a lot more diversified because of the way it works. We are working, we're working very hard to bring our supply chain into the US. And we today have the ability to do a project fully 100% made in the US. Very much dependent on the Inflation Reduction Act, so if it changes, that will probably be a little bit more difficult. We're doing it today, but we do believe that diversity of supply is fundamental for it to work.
Marcus, I wanted to ask you a little bit about the US. So data centers warn that actually, the president's attack on green energy could hurt US in this AI race by creating power bottlenecks. Do you share these concerns?
I think the US administration is definitely right on two things. One is energy is important. And energy is, because energy will fuel the next big wave of data and the AI economy. Second is you need to have a consistent policy on infrastructure, supply chain, and the incentive to bring back supply chain to the regions, to the US. Europe should do actually the same, is also right. Where I disagree, and there I'm with Julian, I would be technology agnostic, because it needs to be an all-of-the-above strategy. We need to build everything which can be built as fast as possible because the demand is there. And we could actually build twice of what we currently build. We have a 5 gigawatt under construction in the US from the demand side, from the tech companies and data centers. But we cannot go faster because of supply chain and uncertainties around tariffs. So my advice would be clear that table, that we have more certainty. And I don't care so much what they incentivize, what they prefer, but I want to have investment clarity. And with the tariffs looming and can go up again, you go slower with investment, which is actually the opposite of what is needed.
That's right.
But the future, so staying in the US, the future of the Inflation Reduction Act, frankly, is still unclear. So what does that mean, for example, for your commitment in the US to renewables?
The moment I have a stable investment environment and I know what I need to procure locally, what I can still import, and I know potential incentive schemes, I can sit, I can calculate my projects, I can approach the off-takers and say, I can deliver you power at that price and we get a deal or not. The moment it's unstable and you don't know to put what into your business case, you pause, you go slower. Yeah?
So this pauses basically everything, right? It means that the race will be slower just because of the uncertainty.
I mean, the uncertainty creates a problem. Clearly, people don't want to commit, not knowing what will happen in the short term. No, so I will say, if there's any advice, quote unquote, or recommendation, let's settle the policy discussions quickly. Yeah. You know, uncertain policy is worse than bad policy. You know, uncertain policy is worse than bad policy. Having said that, I think the Inflation Reduction Act, I know that the current administration has a very critical view of that law, so, you know, played a significant role in bringing in supply chains to the U.S. And I think that's something we should not get lost. You know, you might criticize parts of it. There were things that were very political about it. I mean, but I'm not going to get into the details, but that portion we should not get. That idea of bringing the supply chains to the U.S. is very much a MAGA idea. You know, I'll put it that way. That supply chain, and I think that hopefully when the Republicans are looking at this law, they realize that the incentives in the law that allow to bring the supply chain to the U.S. is very much aligned with the Trump administration policy.
I would like to build on that, because for us as a developer and then building and operating the generation capacity, it's very important to de-risk your investments. And the moment you can buy domestic, it's a big de-risking exercise for your projects, because you don't depend on tariff or geopolitical tensions. And it's interesting to see that over the last 4 years, the supply chain within the US have been strengthened. It's easier for us to buy batteries and solar panels domestic in the US than it is in Europe. In Europe, it's non-existing, and that was part of the policy which was helpful to get it done.
Could I have a snapshot, actually, of some of the conversations? And I know you're agnostic in terms of technologies, but what do you think the energy complex looks like in 5 years from now? So how much offshore, onshore, solar, wind, and actual, you know, maybe fusion and others?
I can give you my opinion. We are a battery storage company, so I think my opinion, the markets are going to be, and I'm in Qatar, so gas and renewables.
LNG.
You know, so that gas and renewables. I think that some of the other ideas that people fall in love with that look wonderful when you read them or look at the labs reports and stuff are not going to happen. There's nothing better than gas and renewables to feed.
And batteries.
And batteries are, you'll need both gas and renewables help with, you know, need batteries. So that's, but I think those two elements are going to be, I think that's what's going to drive the future of power for the next year.
Basically, I agree. I mean, I'm not so much, I'm not interested in what the stack looks like, but what the additional investments look like. So what you add, actually. And there, I think it's clear that we need storage technology. So batteries, it's good for your business, Julian, needed in any case. We definitely need more gas. And then the question mark is, what is the rest? And there I would look at the timelines. I hope that we get a breakthrough in fusion technology, because that would solve the energy problems, not of our generation, but the next and the next one. But we cannot wait for that. But I mean, we should not give up on that. But short term, it is, and I fully agree, it's a combination of renewables, batteries, and gas. Nuclear, in whatever type, will take much longer, and you can also not add significant capacity, even if in the most optimistic cases for nuclear and SMRs in the US, it's by the mid-30s, it's still a rounding error.
How does the growth of AI actually in Germany and Europe delay or jeopardize the exit from coal due to the enormous amount of power we need?
I think that is clear. The slower we are with building new, cleaner technology, the higher the utilization of the old dirty stuff. And we see that everywhere. We have seen that in the US, we see that in Europe. So it's important to get the new technology in the ground.
But how do you see that? I mean, again, I think you want to phase out coal in Germany by 2030. And when do you know whether that gets delayed or advanced?
I don't care so much about the exact date, because you can only close a capacity when you have built new one. But the utilization needs to go down. And that is the important thing. Whether we close it then 30 or 35 as a country, we have as a company have a clear plan. We will get out by 2030. The country might need it longer.
I mean, I'm concentrating in how to serve the new demand, not the old one. So, hey, the coal, might take a little longer, but at the end of the day, I think the real solution, as I said, gas and renewables. No?
In the couple of minutes we have left, I wanted to ask you about money. We touched on it a little bit, but do you feel in general that there's enough capital being deployed in the right places, that there is enough money for this, because it has gone up the priority list for governments, but also for investors? Do people understand it, Julie?
We do. I mean, I think that our customers do very well, and we haven't seen a major issue in getting up to now. I mean, maybe things will get worse or will get more difficult over time, but the capital markets like electricity, like the business, they like the return. So I don't see a problem raising them.
Same for you, Marcus?
Capital is not the problem the moment you have good investments. But if the investments are uncertain, the investors are also much more. We see that as a public. There's a big debate on our shareholder base. It's public that parts say the investments are currently so uncertain in the environment with tariffs and other. You better go slower. And I think we need to strike the right balance to work across the value chain, but also with regulators, politicians, to de-risk the project, because only when they are de-risked, we can get the capital at attractive returns. Yeah.
But I guess politicians understand that this is a race against other big superpowers? And if that's the case, do you think it sharpens and focuses the mind of politicians on what to do with regulation and uncertainty?
My view is it always sounds like that we discuss issues all the time, which is the right thing, because we actually everybody focuses on what needs to be done to go faster in the right direction. And I'm actually optimistic. I'm a strong believer in market forces, and I'm also a strong believer that in the end, maybe it takes some longer and we are all impatient, but that we work across. And many things have been achieved. When you look at infrastructure bills, also in the West, things can go faster than they were 5 years ago. If we move that direction, I'm optimistic.
What are you most optimistic about, Julian?
Hey, I think that changed from the fact that, we were an industry replacing technology to an industry that's now playing an essential role in the main race that we have today, the race for artificial intelligence. So I think that puts a pressure on us to do our jobs better, to think about technology, to think of new ideas. And it also puts a pressure on the people that regulate us to ensure that they give us the certainty and the guidance to ensure that we can make the big investments and create the technology and the projects fast. So excited about that. Hopefully 5 years from now we'll be here and we will be talking about the next chapter.
Yeah. What will we speak about in 5 years? What will we have fixed?
I think we basically probably discuss still the same problems. I think there will be a stronger focus on the security aspect. And if every region has sorted out a security aspect, maybe we start talking even a bit more about global collaboration again.
There you go. We'll speak before 5 years.
That's
Thank
right,
you
yeah,
for a
before
good
that.
panel. Thank you both for joining us today.
Thank you so much. Huh? Thank you. Thank you.
All right, that wraps this morning's sessions, everybody. Please join us for lunch just outside this room. We also invite you to join us for one of our breakout briefings starting shortly in the Fairmont Hotel. Lunch will be served there as well. One of the sessions is called What is Trumponomics for the Middle East? That will be a special podcast taping that is taking place in breakout room 1. And then the other panel is Global Real Estate Supply and Demand will be taking place in breakout room 2. We also invite you to explore the activations and exhibits taking place through the forum space, showcasing the creativity, heritage, and talent of Qatar and the region. Event staff are available outside to direct you. But please join us back here for 2 p.m., everybody, for our afternoon programming. We'll see you back then.
Let's imagine something. You've just landed in Doha and don't know where to start.
Hi there, I'm your personal tour guide. May I know your name?
It's asking me my name. Or maybe you're a resident who's never had time to explore the cultural gems around you.
Nice to meet you, Aya. What do you usually enjoy most when exploring art?
Doha is incredibly rich in art and history. But with so much to see, where do you begin?
Let's choose street art.
Okay.
Museum galleries.
Well, now it's easier than ever.
How much time do I have? I have 5 hours on my layover.
With AI-powered smart tours, your perfect itinerary is just a tap away.
You can now press Create My Tour button and start your adventure. Let's go.
Based on your interest, our AI art specialist curates a Qatar Museum's experience tailored just for you, recommending the sites and art pieces you can't miss.
I wonder what it is. Let me take a picture.
This one is beautiful, really.
Now you can discover hidden gems.
The towering rose sculpture transforms a delicate flower into a bold urban statement.
Tawazun by Shu'a Ali invites you to explore the evolving landscape of Doha.
Experience must-see masterpieces and cultural wonders from Qatar museums.
This is Sheikh Abdullah bin Jassim Al Thani's old palace.
And all of that in a journey personalized just for you.
Please welcome back to the stage, Bloomberg's Jumana Bersechi.
Welcome back, everybody. I hope you had a good lunch. Just a reminder that you can engage with us on social media using the hashtag Qatar Economic Forum. And if you're interested in a complimentary 3-month subscription to Bloomberg News, you can scan the QR code on the screen to learn more. And now back to programming. We have a very busy afternoon coming up. We'll be talking about real estate trends and tourism. But first, we begin with a look at how CEOs are navigating the current market volatility.
Please welcome to the stage Mathieu Chabron, co-founder of TKO Capital, Mark Coombs, CEO of Ashmore Group, and Jenny Johnson, President and CEO of Franklin Templeton, for a conversation with Bloomberg's Eric Schatzker.
Hello again, everyone. Good afternoon. As you can see, this panel discussion is called CEOs in the Storm. I think for a trio of CEOs in the storm, this group looks pretty presentable. Just a little background on our panelists. Jenny Johnson runs a $1.5 trillion global asset manager. I'm sure many of you are very familiar with Franklin Templeton. Mark here runs a $46 billion firm specializing in emerging markets, and Mathieu runs a $56 billion alternative asset manager. So we have a tremendous range of investing expertise and asset diversity here on stage. I think that's a very good place from where to begin. My first question, panelists. We know America First has been destabilizing for the U.S. economy. We know it's been destabilizing for the global economy as well. How? You've been hearing about this. I've been hearing about it. You've been talking about it. Uncertainty, a slowdown, and in some cases, a total halt in corporate investments, a loss of trust in the U.S. as a reliable partner, as a reliable supplier, a breakdown of the rules-based order, stresses on global systems such as supply chains. As I say, we've been hearing about that. We've been talking about it here at the Qatar Economic Forum and, of course, over the course of the past 4 months. However, and this is a really big however, as of this morning, U.S. stocks are within a few percentage points, like 3 percentage points, of a record high, and the MSCI World Index is within tens of basis points, less than a single percentage point of its all-time peak. So what I'd like to know from the three of you, starting with you, Jenny, is what exactly is the market pricing in?
Well, I mean, let's remember, we were just talking about at Davos, right? It was all U.S. exceptionalism, AI, technology advancement, you know, everything was positive. And then, of course, you had Liberation Day, which put the fear in so many people. But I think what people have realized is the Trump administration, and by the way, if you actually look at what he's been doing, he said he was going to do these things throughout the whole campaign, right? And so, you know, it's all about taxes, tariffs, deregulation, and government efficiency. So he'd gone out and said, okay. And you have to remember, in the U.S., you have about 18 months to actually get anything done as a president, because chances are, and in particular this midterm, chances are he's going to lose control of the House in this, and so he won't be able to pass legislation. So he's gone out and he said, okay, I'm going to, and immigration was the other, and he came right out. And on the tariffs, if you're going to get people to the table, and from what I understand, he genuinely believes, post-World War II, that the U.S. has been unfairly treated with respect to tariffs. And so he goes out and he says, okay, I've got to get people to the table, so you come out hard. President Trump is a deal maker. We know that. And that, of course, scared the market, because the numbers and the statements were, obviously shocking. And then, as it's played out a bit, and you hear now Secretary Bessent saying, hey, this is interactive, right? Tariffs go with the tax policy, and they go with deregulation. And so I think now that people have seen a couple of deals, frameworks done, you're seeing the tax legislation move forward, they're getting more comfortable with the story. And so you're getting back to, okay, this is a storm, but we'll get through the storm.
Mark, Mathieu, what do you think? You're active in public markets.
Yeah.
Do these prices make sense to you?
My view, but I guess I'm talking my own book, is it's incredibly expensive and doesn't price anywhere near the degree of uncertainty that it should.
Mathieu?
I think it's a very complacent market. We cannot be that high on the public equity market, and I'm not a public equity person, but when the risk-free rate, or supposedly risk-free, is that high compared to where we were 2 years ago. So there's a disconnect. I think there is a lot of complacency. And I believe right now it's time to be very selective and prudent.
So you were about to say something, Jenny?
I was going to say, complacency about what? Like, what are those risks that you think are?
I think they are.
Sorry, Eric.
No, this is perfect.
He said to make it conversation.
The less folks you hear of me as the moderator, the better off things are.
Happy to, in our view, is the fact that effectively the cost of doing business, defined as effectively what's the cost of liquidity, has jumped significantly, and I still believe that where we are today, and I don't want to just pick the 10 years as a reference, but in general, the cost of liquidity has increased, the quality, the availability of credit is highly, there's a huge dispersion, because the credit markets are not open for everyone, and we know that you need access to everyone to make an economy functional. And I think that here, that's where the public market, being sometimes maybe restrictive because it does not capture a whole economy, or being somehow complacent.
And maybe on the ability of the Treasury to always reprice an issue in significant scale.
U.S. debt.
So I think maybe there's a bit of concern that everybody just assumes we can execute on all these savings via Doge, and we can put a tax bill through where we give tax breaks where we feel like, and it's all going to balance. The risk of execution around that while still funding what is a bigger and bigger deficit. I think maybe that's part of the complacency question, right?
And can I pick up on that too and just use it to challenge you a little bit, Jenny? I mean, what you were trying to do is explain, which is exactly what I asked you to do, why the market's where it is. But I want to know what you think. Do you have that much confidence? Do you feel that there's as much certainty as, again, an S&P 500 and an Morgan Stanley World Index at those levels suggests?
So, look, I think the next 90 days are really important. I mean, look, first of all, earnings this quarter are going to be very interesting, right? Because this is where some of the tariffs have actually, impacted businesses. They've slowed down their spending. I just read something today that 97% of the folks that import are small businesses in the U.S. Now, it's 1/3 of the dollar amount, but so if we don't get some clarity around this, and it really does start to impact, I think we can have a big problem. So I also, but you asked the question on how did we get back, right? And so I think that was a story of back. Going forward, we are in a really sensitive and important time, which I think we'll see kind of how it comes through. If businesses don't start spending again, it becomes a self-fulfilling prophecy, and that is a concern. And then, I mean, the U.S. debt is obviously a concern.
We'll come back to that, I promise. For a couple of weeks in the aftermath of Liberation Day, you heard a lot of people saying that a big sell-off in U.S. stocks had been overdue, and that the world was over-allocated to U.S. assets and equities in particular, and that it was time to rebalance and put money to work in European and Asian and emerging markets, public or private for that matter. Mark, I'll start with you here. How much of that is actually happening? What do the flows that you're seeing show?
Only a little at the moment.
Only a little?
Only a little.
So it's just talk.
It is, but there are two types of flows. Well, I guess everyone's a retail investor in the end, but there's retail and institutional. And the institutional flows just take longer. So if and obviously Mathieu will have a view on this, but if I look at our European and Asian investors, they've already been saying since about 22, when they started seeing the Americans go exit stage left, they've already been saying, how much marginal dollar do we want? How many more marginal dollars do we want? So they're already beginning to look at other things to do. American capital, we're not seeing much of that yet. A little bit in retail and in emerging market equities, a little bit of that's picking up. I think that's a little bit to do with people thinking, well, hang on, there's this AI thing and it's all terribly fantastic, but America doesn't have a monopoly on that. And there's somewhere that is actually quite cheap that we maybe should start looking at, which is China, that is already clearly trying to develop places there and has put some effort into that and has already started to threaten some of the existing players in that space. So it's just beginning. Sorry, carry on.
Over the past 5 years, every dollar invested in the world, 80 cents were going to the US, across the board, public, private, equities, private, fixed income. And so obviously, back to basics, prices were going up because you had this marginal dollar coming in, rightly so. And we saw that, when the market started to freak out a bit, the public market were the first one to react, and partly, the very large cap, presumably the most liquid. And I agree with Mark, we have not yet seen on the private side, because it takes some time, right? I mean, you saw the announcement of some large asset owners that they wanted to sell off the private equity, for example. It takes some time. So the intention, it's not about leaving the US. I think it's about after such flows, you end up with an allocation that is disproportionate towards the contribution of the real economy to the world, GDP or whatever measure you want to take. So I think that's what we're seeing, and marginally, be emerging market, Asia, Southeast Asia. You saw Japan also, yesterday. And Europe, we will see some increase,
I mean,
Jenny, you have a huge... Sorry,
Mark,
go ahead.
The US has 26 trillion of net liabilities. 10 years ago, that was 7. 26, so that 19 trillion has moved in terms of net liabilities in the last 10 years. That is a big amount of money that's come over from somewhere.
Jenny, I was about to say that you have many institutional clients and a vast pool of retail investors. What are those flows telling you?
Well, so a lot of people say, well, did people head to Europe? The European index was the best performing in the first quarter. When we were at Davos, people would talk about, they'd go around the world and they actually would just not mention Europe. I mean, that was like kind of the view, and it's the best performing index. But let's remember, there were things like Germany doing a stimulus program. There were a lot of reactions that happened to sort of the U.S. position that actually made it appealing to switch investments versus saying, I'm losing faith in the U.S. That's number one. True. Second of all, the reality is we are still living in a time of amazing technological innovation. And with respect to AI, we're barely have begun to see. The productivity gains that you've seen in the U.S. are from technologies that came, with the digital assets and, 20 years ago. And that innovation has so far been led by the U.S. And so, I actually prefer, I think it's better for the world to have, more success kind of globally. But you got to ask yourself, why isn't there a bunch of unicorn companies in Europe? what is it structured? It's not like there's not great, entrepreneurs with great ideas. Why is it that they're so focused on the
Shall
US?
we ask the European?
Yeah, I mean, the short answer to that is, you're probably talking about these mega giga caps, who have attracted so much capital to fund effectively, this innovation. I was focusing more maybe on the lower part of the economy, the mid-cap, those people.
I was being mostly facetious.
Okay.
No, what I do want to know, though, is you're right, Jenny, that Europe has not created the same number and the same size of technology giants, certainly, that the US has. But important things are happening in Europe, aren't they? Right? Europe is starting to shift away from decades of dependency on the US consumer, and it's being forced out of the US security blanket, and it's moving toward a position of greater economic and especially defense self-reliance. I say it's an important shift. How important a shift do you think it is, and how are you telling your clients to think about this?
Well, it's actually critical. It's a survival, if I may say, need, and it's almost a re-industrialization of certain markets. Yeah. And here again, I mean, you need to fund that. You're not funding that with some passive public investments. I mean, you need the real money getting into this part of the economy, and defense is an obvious one. It's 3% of GDP. We're going to be increasing that. We're talking multi-billions. That cannot only be funded by public money, because there is no public money anymore. It's called debt, right? So someone has to come, to match that, and that's a great opportunity for private market investors, and that's a global, global statement. And in Europe specifically, I mean, we see the plan that the Germans, have been putting forward. Obviously, in France, under the leadership of President Macron, the many initiatives there, and there is some asks. Actually, I even had that from a US LP, a couple of months ago. It's an inbound call. We want to be more exposed to European defense growth because valuation starts from a totally different level, so you can get the uplift.
Yeah, I mean, I think the interesting thing is that people believe the US always gets it right in terms of entrepreneurial and animal spirits. And there is a slight tendency to think Europe never does. The structural inefficiencies make it very difficult to do. So I think Europe has, yes, we can all buy that, we can all do the trade to buy the currency and think, there's going to be lots of growth with $1 trillion from Germany and 800 billion from the EU. But I think people will probably want to see it proven in Europe, and it may struggle a little bit in terms of seeing it proven for a while. Whereas the US has had the benefit of doing it so many times that people feel very comfortable. Capital gets applied better there. It has its barriers, it's lots of things. But there's a lot of structural reform, there's a mentality, there's horrendous labor markets in Europe to deal with. So I think it's going to be very interesting seeing that hopefully swing into a bit more balance, because Mathieu's right. Europe has got to re-industrialize, basically. It's got to go back to what it used to do very well. And that means infrastructure, energy, smaller companies, larger companies, and of course defense. But it's not just defense. It's about the infrastructure to be able to do the defense.
And if I were to say the one worry I have on the, as I said, it's amazing the U.S. has led so much on innovation, is hubris. Because I talk to some folks and they'll say, look, China's just copied us. That's all the U.S. Well, China's leading in a lot, like robotics are pretty impressive. You look at the EV batteries. I mean, there's a lot going on in China, and I think for the U.S. you have to pay attention and acknowledge.
It's hard though.
Possibly even military. I mean, this little skirmish India-Pakistan, how good was that jet? So there's even that. That's hypersonic. So we've all got to keep going to stay ahead. And you're right, hubris is a risk for all of us, not just for the U.S.
Yeah. What I was about to say is that, again, of course, you're right, that there's extraordinary stuff going on in China. It's hard to invest in.
Absolutely.
So Mathieu makes the point that, there are some easy or somewhat obvious America First trades to look at, like European defense. What are some of the other, maybe not so obvious America First trades to explore? And when I say trades, I don't mean something that you're going to buy today and sell 10 seconds from now. I mean something that you're going an investment, something that, particularly in your case, you're not looking for short-term investors?
I'm happy to start here because there is too much debt in the system, public, private, and that we're coming out of a decade of very cheap, if not free money. There's been even more of those products, put into the system. Right now, the best and single most exciting investment opportunity is to do secondaries, private credit. So you actually buy out of some investors some matured vintages into some direct lending, corporate debt. I mean, you saw, Eric, we're now at 6 to 7% trailing default rate in mid-market corporates. And by the way, this is before tariff. We're talking, Q1. And to Jenny's point, when Q2 comes out. And so now you can be a price setter and no longer be a price taker. And I think this is the position you want to be in this market.
Mark?
Yeah, I agree. Generally, illiquidity is your friend when you have cash. So I think anything where people get a bit sweaty, spreads move out, that's always a nice place to go. And in some ways, there's always distress situations from time to time. But we haven't had a big structural distress trade for a long time because the flood of liquidity has really been keeping things up. So I do think if we get, not even recession, much slower growth, we may see that distress ripple around the world and provide quite a lot of opportunities. Is there a lot now? Bits and pieces. The other thing that interests me is in what I do is the larger economies that need really long-dated assets as they try and build their capital markets and build their own pension systems, where you can fund things in local currencies, you can build things where you're not totally dependent, there's not a big FX risk involved. So long-dated assets in the infrastructure space.
Which markets in particular?
The bigger ones. The Indias, the Brazils, the Mexicos, the Indonesias, here. If you combine the GCC, very, very interesting place to invest in my view. And has some capital that can come alongside you, which is also attractive.
If I could just pick up on liquidity, because you saw what happened 3 weeks ago, a month ago, how quickly the liquidity can disappear. On the treasury market, on the bond market, on the loan market. Remember that we had a month ago the highest, the record in terms of number of days without an issuance of a leveraged loan. That was, even higher than during COVID when the world came to an end. Here, the world was not coming to an end.
And
it was just discussion.
And the 10-year was backing up.
Exactly. So this whole liquidity and the outflows on high yield were all-time high. So the liquidity can disappear very quickly, and that goes back to the complacency, Jenny, where we should be careful that that can disappear very quickly.
The very convenient segue to what I promised the audience I would return to, which is U.S. debt. Last week, I think, as everyone here knows, Moody's became the last credit rating service to strip the United States of its AAA rating. It's a bit of an annoying question to ask, I'll admit, but I do want to know how each of you responds to it. Do you still think of treasuries as a risk-free asset?
Want me to start?
Sure.
One word answer. Why doesn't Jenny start?
No, yes. Yeah, look, I don't think if you hold treasuries today that the U.S. is going to default, right? The problem is when you're looking at it, it's still the most liquid. Where else are you going to put your money, right? What other currency where are you going to put it? And so, yeah, I think it becomes the benchmark still for risk-free.
Mark, your one-word answer
or remains the benchmark.
I agree with everything you've said, but I would say no. I never thought it was a risk-free asset. One of the easiest things to do when you get too indebted is try and inflate it away. And then you can start to take some pain, not just in credit, but in currency. And the currency cost, if you're not a US investor, can start to get painful.
The highest debt to GDP, since World War II, we know what the deficit is. It's not about the default, it's about the fair pricing, of the underlying risk. And unfortunately, that drives the repricing or the pricing of all other risky asset class. So as it moved, and it moved significantly, I'm still not comfortable with the pricing of certain risky assets as a consequence of the level of these so perceived risk-free assets.
So then what is risk-free? What becomes the risk-free benchmark?
I don't think there is any risk-free asset in the financial markets.
There's nothing. So it's as good as you're going to get.
It's as good as you're going to get.
And that's a fair point.
Yeah.
And remember, even when you had cash at the bank in 2008...
If you get inflation, then it's...
But it's as good as you're going to get because
the banks went bust.
What's that?
Even when you had cash at the bank in 2008, some banks who were AA rated on the Friday did not open on the Monday.
Yep.
Yeah.
So here's perhaps a more useful follow-up question to that. A friend of mine who runs a multi-billion-dollar hedge fund drew what I thought was a great analogy the other day. He said if you treated sovereign credits like wine and conducted a blind tasting on fundamentals only, right? Names hidden, you can't see the labels, don't know who the vintner is.
The U.S. would be an emerging market?
The U.S. would rank at least 2 notches lower, he said, than the equivalent of AA+, as in AA-, like France or Slovenia. And there's obviously some truth to that. What really matters isn't whether the U.S. is or isn't considered a risk-free asset. The question that really matters is how much longer can this persist? How long until America faces a reckoning in the bond market?
Who are we asking?
All of you.
I can kick off if you like.
Yes, please.
I think that it has one fantastic tyrannical thing, which is a massive liquid market. And in the end, it can probably last as long as liquidity is where it needs to be everywhere in the curve. And the thing that gets people most concerned, which is why recently was quite interesting, was that curve breaking down and there being real liquidity problems. Because the US has always basically said, we will issue and let the curve reprice. And when they start not necessarily doing that, or they start holding back issuance because they're worried about pricing, then it begins to start as a bit of a reckoning. But I agree completely with Jenny. It's a huge liquid market, and it's something, well, it does, I think the fear of that is driving people to make some very interesting investment decisions about things that you have to ask, what is their fundamental worth? You know, can I eat a piece of crypto? You know, can I?
I was waiting for when you're going to get to Bitcoin.
Yeah.
I mean,
sorry.
No, it's supply-demand. You know, it's like, you know, fine wine. You know, fine wine, they sold Bordeaux in primeur, okay? So over the past 5 years, you would buy the top Bordeaux for 600, 700 euro a bottle, you know, in primeur. The primeur came out last week. They're offered at 300 euro a bottle. It's called supply-demand.
Jenny, last word to you.
Look, it's not a problem until it's a problem. And oftentimes when, you know, a crash happens or a market correction happens, it's something, you know, I was reminding somebody recently that, you know, in 1987, it was the trade deficit. Like, that was the trigger. Nobody had been really talking about the trade deficit, and suddenly. And so the problem is we are in a business of confidence.
Yeah.
And nobody really can figure out, like, what triggers suddenly a loss of confidence. And the benefit the U.S. has, which is allow it to continue to spending the way it's spending, is that there just hasn't been alternatives.
What a terrific conversation. I thank the three of you. Ladies and gentlemen, please join me in thanking Jenny Johnson, Mark Holmes, and Mathieu Chavron.
Please welcome to the stage His Excellency Abdullah bin Hamid bin Abdullah Al Attiyah, Minister of Municipality for the State of Qatar and Chairman of the Qatari DR Real Estate Investment Company, Jeff T. Blau, CEO of Related Companies, and Chi Kun Lee, Group CEO of Capital Land Investment Limited, for a conversation with Bloomberg's Jennifer Zabazaja.
Thank you so much, everyone. Thank you three for being here. We were just having a fascinating conversation backstage, initially talking about supply and demand and maybe looking at real estate through that lens. But before we get into that, I wanted to start where we were just leaving off, and that's asking the three of you who have expansive, diversified properties and portfolios, how you would characterize this point in time for the real estate industry. Jeff, maybe do you want to start?
First, thank you for having us here today. It's always exciting to be in Doha.
You know, I think, as I said when we were backstage, when you think about real estate, people ask, well, how's the market? And I think it's very hard to answer that question. Real estate, our product is a byproduct of what's happening in the economy, what's happening in the world. So when you have disruption, when you have uncertainty, that creates difficulties in the real estate market. So, for example, if we're building office buildings and you have lots of uncertainty in the market, does the tenant, does the CEO want to sign a very large lease in times of uncertainty? So a stable market, more certainty is always good for real estate. And the other nemesis of real estate is high interest rates. So it's always difficult to build a capital-intensive asset when interest rates are high. So the real estate developers pray for low interest rates. So those are the two things that.
Is that your message to the?
That's our pray for low interest rates.
Chi-kun, can you jump in here and talk about it from your region's perspective?
We, as a company, we started as a developer, but in the last few years, we have restructured to become more an asset manager. So that gives us a lot more flexibility. When you are a developer, you use a lot of your balance sheet to do investments to buy land. I think in an environment where business cycles are shorter, political environment, it's a lot more unpredictable. It does make it more challenging to be able to take on big development type projects, unless you're very disciplined in making sure that your entry price is right, you structure it right, and minimize the risks, and making sure that you can get all the leasing done, as much of the leasing done as possible to reduce your downside risk. In my view, this is a time where you don't see things quite clearly, but it does present interesting opportunities for certain high conviction strategies. So for us in particular, I mean, because it's uncertain, we look for strategies that are a lot higher returns, so special situations or private credit where the income stream is a lot more predictable, or in certain asset classes like in the data centers, because we believe in the digitalization sector. And of course, finally, it's on the living, because no matter how the world changes, how disruption takes place, you need a place to stay. When you travel, you need a place to stay, to call it your home. So those are the few things that we continue to focus on, even in a world that I would say it's relatively more unstable and more unpredictable.
And Your Excellency, you say also the cultural aspect is important, because you need to ensure that the clientele is there.
Definitely. First, thank you for having us and hosting us in this panel. I truly believe, like you said, that culture and understanding the culture that you invest in is very important. There are some countries in the world that value an apartment over a villa, and there are other places in the world which actually enjoys compounds rather than separate villas. So understanding the location, the area.
I bet that was business.
Yeah. Seems like it. Understanding the location, the area, and where you're going to invest is very important. So you talked about supply and demand. And a lot of people look at it that, okay, we have too many offices or we have too many residentials. And the fact of the matter, it doesn't work that way. Quality does matter. Location does matter. So good quality offices now are actually in high demand. When you talked about villas in Qatar, they are in major demand in respect to apartments. So you need to really look at real estate as if you're going to purchase art. You really need to understand what you're purchasing and when you're going to purchase it. And I think we live in a very good opportunistic kind of timeline. We have a saying that, real estate does go with the economy, but it will always have something that will pay you back. It's a way of hedging your currency. It's even when the interest rate is all-time high, people don't buy, but people do rent because they have to live somewhere. And that means the rental market picks up. We have seen trends where a lot of offices are not being built But that means just 2 years from now, with the AI movement, if you may, the global movement of AI or energy transition, that means we will need more offices. Post-COVID, people are being told and asked to come back to the office. That means good quality offices, not old offices, but good quality new offices are actually in demand globally. So in the sense of it, you need to understand the culture, the place, and how you're going to work. However, real estate is always a very good place to invest in. We have a saying in Arabic, I'll say it in English, that real estate can get ill, but it will never die.
It'll never die, so it will sustain. Can you talk about, you mentioned paying back in the opportunity. We did just see the US president here in the region last week. Your company signed a deal with them. Talk about the value in that and what you're seeing long-term for that.
So Qatar EDR signed an agreement with Dar Al Arkan, which is a Saudi-based company, developer. It's actually a sister, or let's say a friendly company that Qatar EDR have been working on for a long period of time. They're using the Trump brand for their golf courses, so there is a misconception there. This actual negotiation happened October of last year, so way before any political moves happen. And to be honest, one of the best golf brands is a Trump golf brand. And I think everyone would agree. So we were very happy about this partnership. We have launched, and the Prime Minister yesterday had talked about it, one of our biggest touristic destination project, which is Smeisma. The heart of Smeisma will be the Land of Legend, a huge theme park, and it will have the golf course, which will be a Trump golf course, and all the resources that will be on a 7 kilometers shoreline. Qatar, post the World Cup, have gained a big movement in infrastructure, as you see. We're actually, by the IMD, we are considered #1 globally in basic infrastructure. So we have built our infrastructure, and we can build on that success by building, tourism. And we have a very clear focus for Qatar. And I think, the Tourism Authority will be talking after this panel, but we have a very big focus on family tourism. So Smeisma will be a great project for that. As far as the visit goes, I mean, it's a historic visit. It's the first time an official state visit of the United States with the president came to Qatar. We were very proud of this visit, and I think it just highlights the great relationships that we have with the United States, and we will continue to have.
And you each have talked about some of the unpredictability that comes within the industry. But Jeff, I wonder if you can weigh in on whether or not there is an asset class within the real estate sector that is able to weather all sorts of volatility and maybe you've noticed outperform.
Right. So at Related Companies, we are one of the largest development firms in the United States and operate in London as well. And the answer is it changes over time, but some of the high conviction themes are also around multifamily today, homes, living, new office, and in particular, we've really spent a tremendous time responding to the digital infrastructure demand and building data centers throughout the United States. And so data centers have become a very unique opportunity because you're building the infrastructure to enable AI to happen with some of the best credits in the world as your tenants, signing long-term 15, 20-year leases. And so that's created a whole new opportunity, and the capital demands for the data centers are nothing like the real estate industry has ever seen.
What sort of numbers, if you can?
So, for example, we're building now a 1 gigawatt data center. A 1 gigawatt data center could cost $11 to $12 billion. So you start doing 3, 4, 5 of them, it starts to add up to a lot of money. And if you think about even a big office building in New York City is $2 billion or $3 billion. So these are numbers that the real estate industry hasn't really dealt with in the past. But we think right now, data centers are one of the highest conviction opportunities because the demand is great and the supply of power is short. And while that supply-demand mismatch happens, you're going to have excess returns there. So we like that. We continue to develop multifamily. we are the developer of Hudson Yards in New York City, and so we're actually starting a brand new office building this month. We just signed a 800,000 square foot lease with Deloitte, the accounting firm. So it just proves that the demand for a new office is still very strong.
But we're still not seeing, at least New York, if we talk about New York, levels at where they were pre-pandemic. Does that worry you at all?
In terms of population, actually, the population has rebounded. People left during COVID and now come back. In terms of office, New York is almost fully back to office, at least 4 days a week. You know, I think the world's decided that Friday is a national holiday. So if you get 4 days, that's back to the office. And so, but you're really seeing a bifurcation in the office market between the older B-class buildings and but in particular, brand new. The supply of brand new is low. This building we're starting at Hudson Yards will be the first new office start in 5 years in New York City. Wow. Think about here, you drive around, there's cranes on every corner. You know, New York City doesn't really have too many. But we're now we're seeing that demand again. I think you'll start to see a couple of new starts.
Chi-Kun, do you double down as well, as Jeff was alluding to, on data centers and AI, really?
Yeah, I think, I don't believe that the trend on digitization or digitalization will change. And with AI, with DeepSeek, I think the demand for data is just going to continue to grow. The big challenge, at least in Asia, outside of the US, the big challenge is around whether there's going to have enough energy to be able to support the growth. It's not difficult to buy land to build data centers. The question is water, infrastructure, and power. And if you can get that going, and then the next big question is the capital. I mean, Jeff mentioned just now to build a 1 gigawatt of data center, it's going to cost $10 billion. So there's going to be massive amount of capital that's needed. I think that trend will continue to grow. There's a big question in many investors' mind today is because the AI sector, the technological sector moves so quickly. There are questions around, technological obsolescence, and what does it mean in terms of data centers that you have built, constructed, and maybe used by, whether it is co-location or hyperscaler, 3-5 years down the road, the technology, imagine that the technology has changed quite significantly. Then what do you do with data centers? With some of these data centers that may be outdated. So those are issues that, while the opportunity looks interesting, then how do you capture? How do you position yourself? How do you make sure that you build data centers that's fit for purpose for as long a period as possible?
How do you approach it then with caution? Is that sort of what you're alluding to? Yeah,
and location becomes important. I mean, there are, if you are building AI-enabled data centers, some of the users are quite prepared to choose remote locations. So you need to decide, whether you are prepared to invest in data centers that are remotely located. The issue is if the data center becomes obsolete, then what's going to happen to the alternative use of the asset? Whereas if you choose a data center that's closer to city center, even in the event that the technological obsolescence were to occur, then I think you have a chance to repurpose the data center into alternative uses. So these are issues that we have to think through as we evaluate every single data center investment opportunities.
Your Excellency, do you want to jump in?
Yeah, I just want to add because I agree on everything said, but the capital is there. I mean, if we look at numbers, and I like sometimes to base my decisions on actual numbers that took place. In the first quarter of 2025, on cross-border investment between countries, there was an increase of 57%. So that shows that the capital is there. But you need to be selective in where the capital goes. Also, on transactions. We monitor transactions globally, and to be honest, in the first quarter, if you look at the Americas, they achieved only in the first quarter 93 billion USD, which is an increase of 37% from the first quarter of last year. On Europe, Middle East, and Africa, they actually sold 55 billion USD, which is a 41% increase of last year, 41% increase. And in Asia, they actually achieved 36 billion, which is, I think, 20% increase from the last year quarter. So, as I said, the appetite for real estate will always be there. The boom of AI is amazing, but yes, there is an opportunity, but there's a window, and the window needs to be captured. I always believe that the biggest place that can invest in AI is the Middle East, because we are already prepared. We have a very modern infrastructure. We have the cheapest energy in the world, and we have all the infrastructure ready for databases. But yes, being smart, I totally agreed. You need to be flexible, and you can diversify your real estate from offices to apartments, or from databases to energy transition, or to health centers. And it seems that every time we have a global talk, real estate investors talk about it. Like back in COVID, people were talking about health services and how it's very good to invest in health services. That was just 2 years ago. And now we're talking databases because of AI. Honestly, I think real estate globally is picking up. There are very good opportunities, but it is really picking up from what it was last year. Interest rates is coming down, and I believe they will continue to come down. We're very excited. We believe that the market will grow this year globally, but obviously some uncertainty, geopolitical tensions, trade policies will put pressure on it. However, if you don't invest now, then when will you?
Right. How do you think about this market here in Qatar? You're talking about energy being cheap in the Gulf compared to some of the other Gulf countries. I mean, if you think Doha versus Dubai, Dubai still has a competitive advantage over Doha. How do you think about it from the real estate lens? I see you shirking at that.
No, I'm smiling because you said competitive. I believe that the whole Gulf is one country. I mean, we build on each other. I have a lot of fans.
Clearly.
So we build in what we have. You don't build a theme park next to a theme park. We actually look at, and we have the Gulf Council, and we honestly build in. So what good stuff happening in Saudi Arabia, the big boom and the big investments, we're benefiting from them. One of our biggest tourists come from Saudi Arabia, and that is part of we're as a whole is one country. So Dubai, for me, is something that we're working very closely with. We're actually building on each other. A lot of the people come to Qatar through tourist services. They come to Qatar, then they go to Dubai, then they go to Saudi Arabia. We represent one place. You know, in the World Cup, people don't recognize Qataris from people from the UAE, from Saudi Arabia. So they know us as Middle Eastern, you know what I mean? So in a way, I think as far as real estate, Qatar, touch wood, but we're the safest country in the world as per capita. We have the best schools. We believe that we want to build on that. We want a place where your lifestyle will be different, where you can see your children going to schools without the need to go through security. And for us, this is what you see. You've been to Qatar, you've been through our cities, our new cities, our smart cities, and you know what we have to deliver.
Thanks for that. Jeff, before we wrap up, I wanted to ask you all about potentially what the trajectory for the real estate sector looks like in the next few years. I know we're still taking it day by day, considering a lot of the uncertainty, but what would you say is the risk to some of this growth and some of this capital that you all have put into the properties and the projects that you're working on?
Again, I think the environment, political uncertainty is always a distraction, interest rates, but I think with this administration, we're seeing a much more the beginning of stabilization to occur now.
The U.S., you mean?
Yes, in the U.S. And so I think businesses are starting to get their footing a little bit, and so I think we'll enter into a period of calm. And I think that's why you're seeing companies make decisions like the big office lease that we just signed, like the data centers that are getting built. We own Equinox Fitness Clubs, and we have a Equinox hotel concept that we launched at Hudson Yards. And now we're bringing that to the region. And so we're building 4 Equinox hotels in Saudi Arabia, 1 in Abu Dhabi, 1 in Dubai. And in the green room, I think maybe we made a deal for Doha.
Wow,
so,
do we want to break that news right now?
No, it will have its own announcement.
So I think there's a lot of opportunity to expand here in the region as well.
Chi-Kun?
Yeah, I mean, for capital land, I mean, we have been operating in India, China, a lot of Asia in the last 30 over years. I've been traveling to the GCC quite often. Happy to say that we are starting to look at opportunities, whether it's business parks, industrial logistics, and potentially data centers. And why are we doing this is because we have very deep relationship with many of the companies in China, in India, in Asia, really looking to invest in the Middle East. And it gives us great confidence to be able to look at some of these land opportunities, because we are quite sure that there will be takeout from a tenant's perspective. And as a result, it's really not difficult to be able to raise capital, and will make it quite interesting for us. And even though I always thought that Singapore is quite well planned and quite well designed as a city, but coming to the region and see how well Doha has built up, I think there are many. I want to encourage the Singapore government to learn from the Qatari government as well.
What sort of things are you looking at?
In terms of city planning, the use of energy, sustainability, making the environment conducive. Every real estate becomes usable for the tenants. I think it's a very well thought through in terms from the beginning to the end. And I just want to congratulate the Qatari government for excellent achievements.
Your Excellency, before I go to you, Jeff, do you think some of these models, though, can be replicated in the U.S., or maybe is the U.S. a different model than what we're seeing here in the Gulf?
In terms of the master plan?
Yeah.
I mean, the problem, the U.S. is much more built out than here. So what's great about the region and here in Doha is you have the opportunity to take all the knowledge that happened over decades in the rest of the world and start from scratch. I mean, you would never create the infrastructure underneath New York City if you were starting from scratch. Here, you have the opportunity to take all those learnings and really do something incredible and modern. So each city has its benefits, but that's one of the benefit of kind of creating a city later, right, is all the learnings from the past.
Yeah. Your Excellency, is that some of the learnings that you and the team have looked to? I mean, what sort of markets are you trying to replicate when you look to build up?
Definitely. I mean, our Qatar Vision 2030 was built on learning from others. As we started late when it comes to the infrastructure game. And that's why I'm saying we have the best infrastructure in the world, because we learned from everyone else. Who do you think, who were the consultants that built or designed our infrastructure? They're from the US. We have people from Singapore. We have people from the UK. So everything was put into that. And that's why I'm saying, if there is anything, our infrastructure is the most ready infrastructure to utilize AI. Because we have all the data. AI cannot work without having the data to actually access. All our cities were built and the data is available. So we have modern infrastructure. In the 60s and the 50s, we didn't have any infrastructure, and obviously other countries in the world. And that's why I believe that the Gulf as a whole has a unique opportunity to actually lead in smart cities and actual use of AI in our urban planning.
It's fascinating. We're unfortunately out of time, but really appreciate the three of you having this discussion. Jeff, Chikun, and also Your Excellency, thank you so much.
Thank you
Thanks,
very
everyone.
much. Thank you very much.
Please welcome to the stage His Excellency Saad bin Ali Al Kharji, Chairman of Qatar Tourism for the State of Qatar, and Sebastian Bazan, Group Chairman and CEO of Accor Group, for a conversation with Bloomberg's Jumana Bersetchi.
Good afternoon, everybody. Well, it's good to talk about tourism. It's an uplifting sector to talk about. one of the more fun panels to be on today. Your Excellency, I want to start with you. I know tourism has been a big focus in Qatar, part of the diversification efforts. The numbers were really good. They were solid for last year. You're already at 5 million tourists versus your 2030 6 million targets. You're getting very close to your 2030 target.
Exactly.
Talk to us about how important you expect the tourism sector to be as a driver of Qatar's growth in the next few years.
Amazing. First, I'm very happy to be with you on stage with my brother Sebastian here and talking to this beautiful audience. As you know, everybody in the region or globally, they are looking to increase the number of visitors. In Doha or in Qatar, we succeeded to reach 5 million visitors in 2024, which is like 25% increase from 23. But let's take this opportunity when Sebastian here on the stage with me, we are focused more on room nights. First time we reached more than 10 million room nights in 2024, which is a metric allows us to measure the economic impact or economic growth. This is the most important, I think, for us in Qatar. And every hotelier knows about COSTAR, which is give you indications and numbers about where the tourists came from and how long they stay and things. And I'm very happy to find Qatar ranking #1 in the region with a growth around 22% in room nights, which even all Dubai or Saudi taking the lead in headlines. But #2 and 3 is Abu Dhabi and Kuwait of growth of room nights, around between 10 and 8%. We are building on this, and we try to drive these numbers to grow and to have real impact on our economy.
Is it fair to say then it's not just about the number of tourists who come in, but how long they stay in Qatar?
Yes, this is what we're trying to focus on, how long they can stay in Doha, to extend the staycation here in Doha, and to find what the people looking for here in Doha about adventure, sun, sea, and sand, more quality time with the families, and to use the diversified offering here in our city in Doha.
And Michael Bublé, if you're here this week.
Yes, Michael Bublé on Friday. I hope everybody have chance to that.
So yesterday I had the opportunity to speak to His Excellency, the Prime Minister, and he said one line that caught a lot of attention, that the World Cup was sort of like an IPO moment for Qatar.
Yes.
So it's publicly trading now, Qatar, to continue the analogy.
Exactly.
What are the next big events we can watch out for in the next few years?
Actually, the big events non-stop. activity for us to host here in Doha and to utilize the great infrastructure we have, the stadiums, the venues, the transportation, the connectivity, the great connectivity which Qatar Airways provide also. So in the end of this year, we are hosting two big tournaments, FIFA World Cup Under-17 and Arab Cup for the second time here in Doha, and the F1. So there is three major sports events happening in the last quarter of this year. And around it, there is many, many events in our calendar to activate this great events. And then in upcoming, and at the moment, we are hosting the World Cup for table tennis, and in 2027 Basketball World Cup, and 2030 we'll host the Asian Games for the second time.
Okay, so there's a lot to look forward to. Sebastian, let me turn it to you. I guess it's music to your ears to hear that His Excellency wants to focus on the number of nights, extending the number of nights that tourists remain in the country. How do you look to take advantage of that?
Well, I guess the first thing to say for me is I am in his hand. It's kind of actually interesting to admit we are extraordinarily depending from one another. I am depending on the government of Qatar in terms of vision, ambition, tourism plan, which the Excellency is now leading. And of course, for him to deploy and execute, he is a little bit depending on me and my peers. But let's start first with, he's the decision maker, and I have to listen, and I have to basically be devil advocate, and then I have to make sure I can fulfill the promise. That being said, people probably don't realize it, but I came the first time in this country in 1992, 33 years ago. And I've been coming to this country well above 100 times over the last 30 years. And we have the same baby blues. We, as French, we missed the Olympic of last year. That was the best time ever for France. You in Qatar, and I'm with you, we missed the soccer
As in
cup.
you have nostalgia.
Because no, it's nostalgia because that was the best time of all of us basically describing the best of Qatar and the best of France. So now we basically have to play on it, build on it, and revive it. And it's not that easy. What I've been saying for a lot of time, which is why I love this country, is you have everything. Qatar has everything. From the very first day, started with Qatar Foundation, with university, with schools, with hospitals. Then Qatar Airways is a gem. But a lot of people don't know of the existence of Qatar Museum and so many other things. So what we need to do together, since it exists, since it's being invested, can we please show it off? And this is where we are today, and it's really building up for the last 24 months, better than we all expected. We just have to get going.
Certainly sounds like it from the numbers. So let me just ask you about those numbers. Paraphrasing what His Excellency said, the numbers into Qatar, big growth of north of 20%. Other countries in the region also, in the GCC, around 10%-ish. How does that compare to other pockets around the world?
Well, the world is very easy to predict, and please agree with me, tourism travel industry is a blessed industry since 1970. That industry has been growing between 3 and 5% per annum for the last 50 years. New supply has been growing 1.5 to 2% per annum for the last 50 years. So you had a demand exceeding supply by 2 times. The next 20 years, for sure, demand's going to grow no longer 3 to 5, but probably 4 to 6. Supply will remain 1.5 to 2. So we're going into golden ages where demand's going to exceed supply by 3 times. Why? You need 3 cylinders to grow. Do you have a higher demography in the world? Answer is yes. Do you have a higher growth of emerging middle class? Answer is yes. Do you have a higher means of transport, whether it's road, trains, airport? The answer is yes. Now, you've seen GCC, and I was very happy His Excellency Sheikh Abdullah talked before. GCC, for me, is one country. He's so right. And GCC has been increasing since pre-COVID by 32% in terms of destination, which is 95 million. Oddly enough, since I'm very French, it's still not there yet on France alone, which is 100 million. But of course, GCC is going to be way beyond France probably in 2 years from today. So Now it's a question, you have the demand, you have the supply, and what's so interesting? Out of the 1.6 billion people who travel, they go now much more to the Middle East, much more to Asia Pacific, and less to Europe. But what we need to do is, on any social media, any app, any corridor channel industry, we need to basically talk about it, which is why we have this forum today.
Yeah.
And we need people to stay longer, because it costs a fortune to get somebody to Doha. Make sure they spend that extra 2 nights.
So would you say for Accor specifically, this is the fastest growing region in the world for your business?
Yeah, what people, when they travel, half of social media content is on travel and tourism and food and beverage, half of it. Half of it is about souvenir. What is it that you like? You always forget what people say, you always forget what people act, but you don't forget what they make you feel. No, but I'm very serious. Everything about feeling, sentiment, memories, souvenir, and it's very tough to execute. So what we need to do here, and which is why I'm so attached to Qatar Museum, Qatar Exhibit, fashion industry, there's a lot of things you can do through the luxury segment, which is easier than the standardized mid-scale economy segment.
Your Excellency, talk me through what Qatar is doing on medical tourism. This is an interesting conversation you and I were having in the back, and I'd love to hear more about it and what your plans are.
Exactly. You know, Qatar is one of the highest countries in the world have spending on healthcare. And I think His Excellency, the Prime Minister, mentioned this yesterday. We are spending around 12% from our annual budget on the healthcare. And we are in Qatar Tourism, look at it as like it's an opportunity. And we worked very closely with the Ministry of Health to develop the new health tourism strategy. And we just finished and presented to the PM and got approved. This can help us to capitalize on this investment, to call people to come and enjoy the quality of healthcare here in Doha, and to target on this audience as main target for us. Please come, enjoy our quality of healthcare and our quality and safety in the city. This can drive also more people to Doha and to justify this big amount of investment putting in this sector and also serve our tourism sector. But always what I'm looking for, to use this technology to talk about these projects, about these initiatives. And this is what we are focusing now with AI, with the big tech companies in Doha, and put tourism more closely with the people, to let people, everyone to know what they can have and what they can enjoy here in Doha. If we are not speaking enough as Qatar Tourism, there is many tools we can spread the information and the services, and it's really very interesting working on this.
And is the purpose of that to attract a different demographic than who is currently coming?
Yes, as I mentioned in the beginning, I'm not looking to drive the numbers high, rather than to stay more on the quality of visitors, to enjoy our excellent service here in Doha. In Qatar Tourism, we have something called Qatar Excellence Academy. It's covering all aspects in this sector, from museums, tour guides, DMCs, taxi drivers, teaching people, even tour operators out of Doha, about what we have here in Doha. And using also our partners as Accor or any other hotel company to talk about Doha and promote Doha more and more.
Sebastian, you were saying you've been in Qatar since 1992, is that what you said just now?
Yeah.
Okay, do you feel like because you've been here longer, you have a competitive advantage over the other hotel operators who were looking at the region as well? Because there has to be more competition now.
I wish the answer is yes. I don't believe so.
Why not?
Well, because the Qataris are very demanding. They love me for who I am, but they want tomorrow.
That's a good thing. That's a high standard, though.
So it's no. I think I have a better read on the Qatari officials and have a very deep relationship. But that's good. But that's not good enough. So I know, and the more I know them, the more they ask from me. So I guess. But seriously, it's the difficulty of this country, and it's one, and it's being addressed. we don't have enough luxury beach resort experiences. They built it in Dubai. They are building it today on the Red Sea in Saudi. They built it in Abu Dhabi. And we are, I say we as Qatar, we are late in this country. And most of the luxury hotels today still don't have great beach access, which is why altogether for the last 4 years, we basically launched this Land of Legends and the golf resort, all that $5 billion investment being made by Qataris and non-Qataris, by the way, the theme park, the water park, the retail done by Land of Legend, which I am associated with, we've been saying to the Qatari official for the first time, we want non-Qatari to put the money at work. We're going to put skin in the game. We're going to build it. But that is what's missing in this country, is people will come here if they have entertainment, leisure, water park. I know Qatar Fan exists and Qatar Fan is being built. I'm just saying we need more of them and we need to go quick at it because other countries will offer the same thing and hopefully not sooner, but we need to catch up. Sorry, I should not be saying we. I'm an outsider, but I guess.
No. I thank you for this frank answer, but all what he said, it's already been addressed on. We happy that the SMESMA project has been announced, and it's a big investment, 20 billion real investment, I think will drive the tourism sector forward, and as a new product, a new offering to utilize the beautiful beaches of Qatar.
What's the name of the project?
It's a SMESMA project. It's 20 minutes drive from this hotel, and it will have the great Land of Legends theme park with different kind of offering resorts will be around it, with a great golf course, which will give a great experience for the visitors. We'll announce tomorrow, and we will sign here the first PPP project between Qatar Tourism and Public Works Authority and Ministry of Commerce and Industry. And further details will be announced in tomorrow's press conference. It's a project about development, new development for the new beaches here in town, in Doha. We are developing also the beach for this hotel, which is missing. And by the way, we stopped licensing new hotels in Doha. We have around 40,000 key rooms and 7,000 key rooms in pipeline. The only hotels I will gonna give a license to it is beach or waterfront resorts and hotels. This is what's missing in Qatar. He's right, but we are working on this.
Sebastian was onto something then. How do you think about the interplay between luxury and sustainability?
Actually, luxury and sustainability is very well integrated here in Qatar, in every and each project being developed for the recently in Doha. For worth to mention, Ras Brook resort, we have great Habitats hotel there. It's been built in a Marine Biosphere reserve. It's UNESCO designated area. It was very environmental strict areas, but we developed great luxury resort there. QNCC, the Qatar National Convention Center, it's one of the latest, it's been there for 10 years, and it's the first convention center in the region have LEED certificate, which is also focused on sustainability and luxury. Misherab downtown, it's very well designed as a luxurious place and also environmentally friendly. So luxury and sustainability is really very well integrated by design in Qatar.
Sebastian, earlier you were talking about people remember how a place made them feel as opposed to what they did. How do you maximize customer experience in your hotels?
Well, it's all about service. We talked about AI a little bit. AI will be an enhancer before and after the stay of the client. During the stay, anything which is human interaction, smile, service, expertise, they do something before you ask, is what you remember. And I hope all of you staying here in Fairmont and Raffles will remember the quality of the people you have met. I want to do a side note because I don't want to forget about it, and I haven't talked about it with you, Your Excellency, is what we need to do together soon is we need to target India. India will be a game changer when it comes to international emitting markets. People, we go to India quite a lot. You have today 40 to 50 million Indians traveling away from India. Americans are 160, Chinese are 160 million. I guarantee you within 3 or 4 years, that number will go from 40 to 50 to 150 million, only within 3 years. Those people from India will go east, they're going to go to Southeast Asia. West, they're going to go to GCC. And those people don't know the world yet. They are the emerging middle classes. They need to be caretakered. We within Doha, we can welcome a lot of Indians, hundreds of thousands will actually reach your target. We need to go at the source. Qatar Airways is the best equipped. Indigo Airline is the best equipped. This is how we should actually battling together, is go to those source and basically invent for them what they're looking for, which is warmth, culture, interactions, entertainment, and memories. It's absolutely doable. Sorry, I don't know why I said that now, but I guess.
But worth to say on this point, we are, India is in tier 1 of our priority markets. And what we just published recently, that every Indian who got UK and Schengen, US, Australia visa can enter Doha with visa on arrival. I think this will enable more to target more Indian visitors to Doha. Also Pakistan. So this is a very important market. We are looking for more slots for Qatar Airways with India. There's great potential. And I think they will have the great experience here in Qatar.
Final quick question for you. I'm going to put you on the spot. So I have only ever been to Qatar for business purposes. Let's say I want to come and do a 1-week visit because you want longer hotel stays, and I want to stay for a week with my family. What should I do?
It will not be enough to explain all this for you in this 30 seconds.
Obviously, I have to take a Qatar Airways flight to get here.
A lot of things. I'm sure you will have the best time for you, especially as a family. It's suitable for all types of travelers, all different ages, with the wide offering of shopping experience or culture experience in beautiful museums here in Doha, traditional souk, the culinary, the food in Doha is really great. And I'm sure there's many of us, food is the first factor to decide where to go. And I'm sure they can have the best meal here in Doha for you.
Jumana, the head concierge here is called Randy. There is 3,800 clés d'or in the world. Accor has, I think, 120 of them. Randy will give you by 5 p.m. tonight absolutely everything for 7 days within Qatar. You're going to have it. You'll be very surprised. Everything has been prepared for the World Cup. When we send 12,000 people here, it's already existing. It's already being planned. Make sure you do spend a week. I'll give you all the excuse in the world, but yeah, 5 p.m. you'll have it in your hotel room.
And by using Visit Qatar application, it will give you a set or already itineraries for 3 days and 4 days and 5 days itineraries. It's already there.
Well, I started off saying this is going to be one of my more enjoyable panels. No offense to the other panels, but this was very fun. Thank you so much, gentlemen. Thank you.
Thank you, Joanna.
Thank you very much.
Thank you.
Please welcome to the stage His Excellency Hassan Al Thawadi, Managing Director of the Supreme Committee for Delivery and Legacy, for a conversation with Bloomberg's Jason Kelly.
All right. Well, it's great to be with you. Thank you for spending some time. We've been talking a lot, and obviously it's literally in your title, this legacy. And let's start with what I think a lot of this audience knows, and certainly I know from looking after the business of sport. The legacy of the World Cup is one of the most interesting stories around, especially at this moment, as back in North America, we think about the World Cup, and then obviously in 2034, it coming back to the region. If you had to distill down the single biggest lesson from hosting the World Cup, what would it be?
Well, to start off with, I think one of the biggest legacy elements of the World Cup is the fact that I'm still talking about the World Cup.
Yeah, right.
So I think that's a starting point. Thank you. No, I mean, distilling one single lesson. You're trying to distill 13 years of toil, but I would say knowing what we wanted. When we entered, whether the bidding stage or on the delivery stage, from day one, we knew exactly what we wanted out of this tournament. We knew that we wanted to retain a legacy. We wanted this event to be an accelerant, a catalyst for positive change, both in the country and within the region. We worked towards that goal. We realized the challenges that were ahead of us, and one of the most important legacies that we wanted to leave was the human capabilities in terms of delivering such an event, and we worked diligently towards that. So the simple lesson, I guess, is knowing what you want out of this event and out of this tournament. We knew from day one what we wanted, and we worked very, very hard towards delivering on it.
Yeah. It's interesting. I don't think I'm giving away any state secrets. You are often asked for your advice from host cities and host countries. What do you tell that beyond that lesson? What do you tell them in terms of there are North American cities who've never hosted something of this scale? Is there something that they have to do, either logistically or even philosophically, that comes to mind?
I think, well, to start off with, again, the first and foremost element is knowing what they want. I think, again, I keep telling any city or any country that's hosting this to be very, very clear about what they want and working towards that. That's the first aspect. The second aspect, operationally, if you were kind of to distill it down a little bit, on an operational level, communication. Communication is vital. Communication amongst the operating team. Communication, I think one of the levels of success that we showcased in the World Cup was the security level that was present in our World Cup and the success that came out of that. And again, a statistic that I always love saying, not a single English fan was arrested during our World Cup. Hasn't happened since, and so far it doesn't seem like it's happening, before or since. And one of the main reasons was the collaboration and coordination with the security officials, along with the operating team inside the stadium, transportation, and so on. There was a very clear communication plan. In the event anything changed or whatever circumstances got imposed on you, the ability to deal with that change, and again, communicate it on a lateral basis internally amongst the rest of the team, but also, very importantly, with the fans themselves. So fans would not be surprised, and to the extent that they were surprised, there was an open line of communication between us and the fans so that they're able to understand what is happening, what do they need to do, who do they need to go to address that. And I think that led to definitely a very seamless fan experience, and from our side, I'm very proud to say, a very seamless operation.
And so, and you alluded to this, you're still talking about it, but you're talking about it in part because of, and I'm using your own word, the catalytic effect it had on this country and on the region. I assume you hoped that would be the case.
Yes.
How does that manifest? What does that look like, and how does it influence you going forward?
You mean in terms of how did it impact the region?
Yes.
I mean, I think the event, and I say that again with a lot of humility, but I think the state and the region got together in hosting what I will say, until I see otherwise, probably the best sporting event as of today in history. Whether you're talking about, like I said, operationally, fan experience, the impact it's had in terms of bringing the world together.
Right.
If you look at the fact that you had, let's call them the global north with the global south. Initially, our view was this is an Arab World Cup, and the Arab world will be welcoming the rest of the world. But then it evolved and manifested itself in terms of the global south being very present over here, and the global north embracing that diverse culture, and it became a global carnival. Regardless of the fantastic tournament that happened and the football that happened, it was truly a celebration from beginning to end. And I think what that showcased is the fact that this region is not an afterthought or a nice to go and, dare I say it, be a cash grab. The fact is this region today is a significant player and can actually host major events, and not only just host them successfully, but rather add value to that event, elevate the quality of that event, elevate what's happening. And I think, I say it, maybe it's not a direct causation, but today you see, for example, Saudi and what's happening in Saudi. A lot of the major events that are happening over there. For example, in boxing. Boxing has been revolutionized to a large extent as a result of what's happening in Saudi, and the ability for Saudi to host some of these major events and so on, sporting events. Today, for example, Morocco will be hosting the next edition of the World Cup, and Saudi will be, it will come back, the World Cup will come back to the region for Saudi. And I think everybody today is not looking at these nations and saying, why are we going there? Or how did that decision come about? Or what is the tournament going to be there, with a lot of cynicism, which we faced for 13 years, but rather, what is next?
Right.
People are expecting that, what's going to come, any event that's being held in this region, they're expecting 1,001 kind of night experience.
Yeah.
And there's no doubt that the World Cup paved the way for that.
And so on the what is next front, the World Cup is sort of one of one when it comes to events, as you've said. So what are the other sports that are most interesting to you in this state and in this region that you feel you can sort of use that same sort of formula for?
Well, I mean, look, first and foremost, football will always be the number one tournament or number one sport over here. Right. I think it goes without saying. So we've got, for example, this year we're going to be hosting the Under-17 World Cup. We're also going to be hosting the Arab Cup, which we hosted in the lead up to the World Cup. And I think the Arab Cup, in the lead up to it, there might have been an unawareness of it. Then it just picked up, and it just became such a great event and literally galvanized the entire Arab world, not only within our part of the world, but rather the Arab diaspora as well. So that tournament, I think, in itself holds onto its own. But then there's other annual events that keep on coming. For example, you've got the Formula One. There's a lot of, for example, tennis continuously come. We've got the Intercontinental Cup. And there's a few other events as well that will be, I'm looking at, the heads of the tourism over here in front of me saying, am I going to be announcing something out of the way? But no, I mean, look, sports in the end, a lot of the other events that you might be hosting, which would be fantastic, a lot of cultural events, a lot of conferences, but ultimately sports is the one that galvanizes a lot of these. And I think, we've got, for example, paddle today, part of the paddle tour, which I think is a growing sport as well globally. Both in terms of participation, but also viewership, and that's one of the events that we're hosting. Tennis, the MotoGP. I mean, it's a kaleidoscope of major events. But dare I say it, all of it's centered around major footballing events.
Right.
This is what's happening in our part of the world, or let's say in this state. Obviously, in the region, you can see what's happening right now. In boxing right now, Saudi Arabia is taking boxing by storm. I think esports is going to come very, very soon towards our part of the world. Saudi's hosting the Esports World Cup. There's a lot of discussions and exploration about other forms of esports as well. And, there's a certain major sporting event. I think the Olympics will always be on the horizon. Yeah. And people will always look at the other major sporting event that brings the world together in an unprecedented way. So the Olympics is definitely something I think that is on the horizon.
Talk to us about sports as sort of an economic development engine, because we were talking about this earlier with some of the team owners, Mark Adonacio, Ted Leonsis, Amanda Stavely, this notion of a sports ecosystem that, lifts things beyond the fans, obviously has a profound effect, as we see around Qatar as it relates to infrastructure. But even beyond that, the sort of economic sort of engine that it creates, how do you take that beyond sport into broader culture?
Well, again, it's how you approach it from the very beginning, right? If you look at it purely as a sporting event, and I think everybody's evolved from that.
Sure.
Most either nations or even most team owners have already evolved from that and looked at it as a catalyst. So whether you look at a stadium, how do I build real estate around it? How do I make the stadium usable 7 days a week, not just during the tournament and come back? And so, whether it's hotels, whether it's training centers, whether it's museums, whatever it may be that attracts footfall on it. On a nationwide basis, again, you want to look at what's the industry that this sporting event can create. When we looked at it, obviously we were at a time looking at upgrading our transportation infrastructure. And so we looked at this event and how can this event be applied in terms of, upgrading the transportation infrastructure tourism for us, which is always the more immediate beneficiary of these major sporting events.
Sure.
So you look at tourism today, and how can this sporting event, function and work hand in hand with the tourism authorities to ensure that it's sustainable and it becomes a platform that launches the tourism plan. And I think, if I'm not mistaken, I think that, Saad maybe mentioned it earlier, today we've been addressing I think we've overreached our numbers, right, if I'm not mistaken. 2025, we're talking about 5 million visitors. I think that was, in the original plan, might have been in 2027 or 2028. I'm not exactly sure about the timing, but we've definitely accelerated our tourism KPIs quite extensively. It's how do you utilize the entire resource of the nation and the state in terms of capturing all these economic benefits and economic goals. The infrastructure today has led, of course, to Qatar being a global hub for major events, but also a global hub in terms of economic activity as well.
Right. And so when you think about the continued ambition, the ambition leading up to the World Cup and the ambition coming after, what are the either historical analogs that you look at or sort of current, the peer group that you think about in terms of, okay, I want to be like that, whether it's a team or a league or a person, like who are some of your North Stars?
Well, I'd like to start off by saying I think we are a North Star today.
Okay.
So let's just start off with that.
Quick flex,
a
North
little,
Star.
I'm sorry, the little pride kicks in, so I apologize for that. I mean it with a lot of humility, really. But I'd like to think that we have, evolved into being a North Star. But I think just having a conversation generally about the sporting industry and generally about the value that gets extrapolated out of the sporting industry. We were talking about this earlier. I think one of the duo that I look and the teams that I look as having captured the essence of this is, for example, Wrexham, right, and Ryan Reynolds and Rob McElhenney, right. What they've been able to do with Wrexham was create a narrative, create a personal connection to that club, and as a result of that, add value and create value, regardless of what was happening on the pitch, which was phenomenal, of course. Historically now reaching potentially the Premier League in a record time. It hasn't happened before, but apart from that, they were able to create a story out of this that people connected with, that the local, it revitalized Wrexham in a way that nobody imagined it. I was talking to Ryan a while ago, and what he was saying was, when him and Rob were walking down the street, people would come up and say, one lady actually said to him, we never thought anything good would happen to us. Thank you very much for what you've done. So the way it galvanized the society, so it had an impact on society. The team itself started, again, anybody who might have thought about investing before would have thought that was a ridiculous investment, high level of risk. Today people say, wow, look at the value that came out of it.
Right.
But they created stories out of it. It wasn't just a football team. It was stories out of it. That was a phenomenal, that was definitely something that you could, I look at and emulate. And, I'd also be remiss at, not mentioning just one achievement as well for people that I have a lot of respect for. Amanda and Mehrdad, who are sitting in the, I can see them in the crowd. What was done with Newcastle as well is a phenomenal achievement as well.
Yeah.
In terms of the storyline, but more importantly, the work that was put in, to be able to achieve, and I think historically and emotionally have, again, everybody who supports Newcastle kind of just follow up in that. So I think the secret generally is the fact that I think whether it's sport, we live in an age today where it's an attention economy. I'm not the first person that said it, I'm not the last person that's going to say it, but we live in an attention economy. Whether it's football, whether it's basketball, whether it's golf, whether it's a conference, whether it's a TikTok star, everybody's fighting for attention, one way or the other. And I think when sport out of every other, let's say, asset class or every other event, has the strongest ability to create that spark of emotional connection with people. But the idea is then how do you create that value and maintain that value? And the examples that I've just said have been able to create that long-lasting relationship, that long-lasting investment into the team that continues giving and adds value and adds, more importantly, loyalty.
Right.
And so ultimately when I say to any event, anything that we're looking at, whether sporting or otherwise, ultimately there has to be that emotional connection that builds that brand loyalty or that team loyalty.
Well, and Ryan and Rob, to go back to what you were saying, talk a ton about storytelling, and you've mentioned that as well. When it comes to that, I know you have some ambition as well in the film business and the film industry, and sort of continuing to build on what is a long legacy here, but maybe a quieter legacy. How do you accelerate that, or how do you amplify it? I guess maybe a better word.
Well, I think to start off with just, again, just one little I think storytelling is part of our tradition. I said this, I think, a couple of years ago when I was on stage. Storytelling is an ancient part of our culture and tradition in the entire Arab world. I think, if you look at film industry, specifically, for example, the Egyptian film industry and otherwise, some of the oldest film industries, as old as Hollywood, if not, some of them might be older. But I think, today, unfortunately, we don't have our stories or our content being, creating the blockbusters that other nations have been able to create. So I think that, for what we want to do is, one, create a collaborative effort amongst ourselves. So, I was just recently in Cannes, had great meetings with a number of different people working within the industry and some of the countries as well, neighboring countries, about looking at areas of collaboration and working together in terms of, becoming a gateway for international production, because that always gives the exposure towards improving our storytelling capabilities in a way that international audience consumes it. But at the same time also harnessing the talent of our people and harnessing the talent of the content creators of our region to be able to create those content, to create the content. But it's important to focus, like from the way we view it as well, when we're talking about the global market, it's not purely focused on, getting, for example, the Grammy or the Oscars and looking towards the West. But more importantly, there's markets also in the East. Indonesia is definitely a quiet market that's looking to wake up when it comes to content creation and content consumption. If you look at the East, there's significant markets that have already established themselves or are establishing themselves. And I think there's room for our content to travel there as well. So I think the idea for us is to, initially we're talking about the region as our part of the world, the MENA region, the Arab world. But I think it can very quickly evolve towards being a global South part where we create content for ourselves, to be consumed by ourselves, and then push for it to become globally consumed or also move westwards.
And so what gets in your way? We're going to wrap up in just a minute, but what gets in your way of that ambition?
I've been very positive. Don't make me do that.
What do you worry about?
What do I worry about? I mean, look, I think I gotta take a second to think about this. It always becomes a question of timing.
Yeah.
Right? I think everything that we do today becomes a question of timing. And making sure that you do it in the right way, you build it in the right way to ensure that there's legacy. But sometimes you need to capture the opportunity before you're fully ready. And that's where you need to create the balance. Are you, it's always a question that's in your mind. Am I really, jumping the gun right now and taking, because this opportunity is in front of me and it's the last opportunity, and am I grabbing it without being fully ready? And then all of a sudden, you don't deliver upon your promises? Or am I being too cautious and saying I'm still not ready, and the opportunity then passes away?
Right.
And I think that's where you want to create the balance. To start off with, I think what we're viewing our approach when it comes to the creative industry is a collaborative approach, not a competitive approach. Obviously, there's always going to be a level of competition. That's the nature of things, but in a very collaborative way as well. But then the idea becomes, in doing that, are we moving in the right direction together at the right time? Or are we missing out on these opportunities, and then we have to rebuild from. So I think the question of timing and making sure that we're not overly cautious or overly ambitious.
Yeah.
Ultimately, though, it's one thing that I think, for me personally, but I know the state of Qatar always holds itself to, which is delivering on our promises. And I want to make sure that we do deliver on our promises. And every vision that we put together or we present is one that we work very diligently towards delivering on it and not failing the people that have put their faith in us.
Well, because is it fair to say that part of what you did learn, to take us all the way back to the beginning, from the World Cup was that ambition is your friend, and that maybe it is worth sort of extending a little bit.
Ambition is your friend.
Yeah.
Aim for the stars. Make sure your feet, though, are still touching the ground. So you're a bit more realistic while you're very, very audaciously ambitious. Being resilient, being resourceful, and being tenacious. Mm-hmm. I would say these are the factors, if you will, that you need to put in yourself to kind of move forward. I'm looking at the CEO, the new CEO of Badr Al-Mir, CEO of Qatar Airways. Please, if somebody can put the camera on him. And Saad as well. I think they're well.
Nothing if not ambitious.
Well, by the way, no. But if there are two people that really represent this, by the way, I would definitely look towards them as two people that really represent these qualities that I put forward as well.
You're quite good at this. You're right on time. Thank you very much for your thoughts. Thank you for your attention. Great to spend some time with you, and good luck with your ambition. Thank you very much. Thanks.
Thank you.
Please welcome to the stage Yusuf Mohammed Al-Jaid, CEO of Qatar Financial Center, Ola Dudin, co-founder and CEO of BitOasis, and Emmanuel Givanakis, CEO of the Financial Services Regulatory Authority at ADGM, for a conversation with Bloomberg's Ana Herrera.
Good afternoon, everyone. Thank you for being here with us. We're going to get right started because we have a very big and broad topic that's very much in vogue again these days, and we don't have much time. So we're going to chat about crypto, what the outlook is from a regulatory perspective, from investors, from a country's perspective, a financial center's perspective. Emmanuel, I want to start with you. So Abu Dhabi was one of the first, and the ADGM was one of the first, regulators in the region to come up with a framework. Can you tell us what sort of the thinking was behind it and what the lessons learned have been so far?
Thanks, Anna. The thinking was really from the genesis of our fintech agenda. So we launched a fintech agenda in the beginning of 2016, and that then evolved our thinking. And we had a lot of engagement, interaction with the fintech industry as a whole, from the tech side to the financial services side. And one area that kept cropping up was digital assets. So we thought, well, let's look at what the risks are as a risk-based regulator, an activity-based regulator. And we decided, let's try and build a framework around those risks that this type of activity will present. So we built that in 2018 when we launched our digital asset framework. I mean, the key risks for us in our framework were money laundering, obviously, number one. And then we had investor protection, so things like suitability, disclosure, etc. And what flows on investor protection is custody, safekeeping of assets. So we applied the full regime on those areas. We also looked at market abuse, if there's an exchange operation. So we applied our market infrastructure framework, but we tweaked it to make it work for the digital assets. But our digital asset framework was much broader than just crypto. So we tackled crypto, digital securities, and fiat reference type tokens, stable coins, etc. So we took a very big, comprehensive approach, but we put the bar high as well, because ultimately, we wanted to make sure we could mitigate the risks because it was a very new area and no one else had really tried to tackle it.
And notoriously, it's had big ups and downs and big explosions. So Yusuf, Qatar has taken a very different approach to crypto, but you've been very active on blockchain and tokenization. So can you talk a bit about what you've been doing here in that area?
Yeah, thank you. So we're the financial center. We're pretty much the same as ADGM, except we have a slightly different operating model in that we are an onshore legal environment, and businesses that set up in the Qatar Financial Center can do business onshore freely, which means you're taxed and there are no physical boundaries. So we have to be a bit more cautious and coordinate with the local regulators when it comes to digital assets. But if we go back to digital assets, a lot of people confuse digital assets with crypto, and digital asset could be any type of value in digital format that could be transferred and owned and powered, of course, by blockchain or digital technologies. But, crypto is just one vertical. You have stable coins, you have central bank digital currencies, you have security tokens, you have utility tokens. So, there's a great universe out there in terms of digital assets. When it comes to the Qatar Financial Center, obviously the policy of the central bank in the state of Qatar is that crypto is a no-no. And for us, crypto is a no-no. Even trading crypto is heavily regulated here, even if you do it through the local banks. So, you know, our entire focus and resources and investments has gone towards tokenization. And the reason we've gone that route, not to say that we haven't tackled the other verticals, but most of our focus is on tokenization because, first of all, tokenization solves a real problem we have in the economy, especially when it comes to real assets. Democratizing, you know, real assets such as securities or such as real estate really helps drive the economy go forward. If you look at the universe when it comes to tokenization, I mean, you have $30 trillion of tokenized assets expected by 2030. You have $15 trillion of illiquid assets being tokenized by 2030 as well. And then you have $8 trillion of security tokens expected in 2030. So I think there is a lot of focus on tokenization. We believe it solves a real problem for us. We're going to focus on it. We've issued regulations when it comes to tokenization. We have the digital asset regulation that was launched in 2024. We have the investment token rulebook as well. And we have guidelines for security tokens. We've been able to put a framework to start licensing digital asset companies in the KFC swiftly, efficiently. Some of those entities, when it comes artificial intelligence technologies, are non-regulated, so we've taken a very liberal approach. We've licensed them in less than 24 hours. For the more regulated activities, we have plugged in central bank regulatory framework which applies to the entire state of Qatar. You can still benefit from the legal environment in the Qatar Financial Center, have English common law in terms of registration, but when you conduct that activities, digital asset activities, you have full access to the onshore market and you're regulated by the central bank, and that's the approach we've taken.
So Ola, you're as a business in the region, right? How do you approach the fact that rules are still a bit fragmented? How do you go about, you know, working somewhere where just, you know, in the region there's a difference, not to say mean globally even?
So as BitOasis, we've been the first and today one of the largest crypto asset platforms based here in the region. We're headquartered in Dubai, and we've got regulatory licenses between the UAE and Bahrain as well. So those are the two countries or jurisdictions within the GCC where we see regulatory maturity for broker-dealer businesses that are trading crypto assets. Spot largely what we're offering, and I think we're seeing some frameworks being developed for the crypto derivative markets as well. So our licenses that we have purely broker-dealer in terms of activities, and we, as part of that, can offer custody as well. And I would say the market is fragmented from regulatory perspective, correct. But overall, I think the MENA market and especially the GCC has been, in terms of demand and growth, has been amongst the fastest growing markets. The two fastest growing markets in terms of adoption is the UAE and Saudi. And Saudi actually between 23 and 24 has grown by over 150% in terms of crypto adoption, despite the slowness in the market, at least in 2023. Now, obviously, the market has really kicked off. UAE obviously is on par with the Saudi market in terms of growth, and majority of our activities today is focused on the UAE market. Obviously, we've just secured the Bahrain license and will allow us to serve high net worth individuals or qualified investors, with crypto services across the GCC market. But from a retail perspective, obviously there are still challenges in terms of regulatory clarity in some jurisdictions across, not just GCC, I would say, but also across the region overall. Definitely for us as, builders, entrepreneurs, operators in this space, having more homogeneous regulatory frameworks, perhaps passporting, agreements are set up would definitely help us continue to grow and scale and tap into the market opportunity in a regulated market. Because the reality that we're seeing when there's lack of regulatory clarity, especially in large markets, for instance, like Saudi, Egypt, other markets across the region as well, the demand is there, and that demand is being met. However, it's being met by unregulated platforms, sort of, underground type of markets that really exposes consumers to risk. And similarly as well, there's a risk of, higher risk of money laundering, terrorist financing, and all of that comes with unregulated activities. So we try to partner up with regulators, share our know-how from a public policy perspective, and then once licenses are there, be amongst the first to get those licenses.
So just one quick follow-up. What do you think is driving this increase in demand in the region?
I think there are several reasons. First of all, I think the demand that you're seeing across the GCC is quite different to the demand that you're seeing, for instance, in other places across North Africa as well, Egypt, etc. In the GCC, largely, I would say investment in a new asset class. So, Bitcoin in the last 3 years, in fact, even in the last 5 years, has been amongst the best performing, assets in terms of an investor portfolio. So over the last 3 years, it has appreciated by over 290%. And overall, obviously, if you've been early in the market, you would have done significant gains. So overall, I think it is really investment in a new asset class that has been high performing. Bitcoin, I would say, more specifically. And then what we're also seeing, and that's an adoption, not just in the GCC, across the region as well, the usage of stable coins for cross-border payments, paying freelancers, online payments, remittances, etc. And I think that's where regulatory clarity is very important, because crypto is not just crypto assets. And I think also, Yusuf, you just mentioned there's the tokenization part that requires a different regulatory framework. There are stable coins and payments that also requires a different stable coin framework. And we're definitely seeing regulators across the GCC catching up to that. So I think there are different use cases, but overall, I think there's sort of the right product market fit when it comes to that type of application, payments, investments, and later on, obviously, tokenization as well.
Emmanuel, just taking a step back to the global fragmentation and regulations, you obviously will be speaking to your peers. Do you think there will be more harmonization? Because part of the play in crypto, we've seen exchanges move from one country to the other, have part of the business somewhere. So is it likely that there will be harmonizations? Is it needed?
I like to think of it as alignment. And I think rather than harmonization, because unlike sustainability and taxonomies, which I won't go into today, there's been a gap in regulations. So rather than there being a whole host of regulatory frameworks that are competing with each other and not quite aligning, we have a void. And some of us have jumped in much earlier than even the standard setters and developed frameworks in that void. So like what I was describing earlier in 2016, 2017. What happened in the last 4 or 5 years is that in particular, IOSCO, which is the securities standard setter, in essence. And the annual meetings were in Doha here last week. And one of the key 3 topics was crypto and virtual assets. And it has been for the last 4 years. And there's been a lot of work done amongst the members of IOSCO to develop a harmonized, principled approach to the regulation of crypto. And last year, that came out in some more formal documentation. But that was a consensus-driven alignment. The good thing for us was that consensus and alignment fitted well with our framework, because it tackled the same risks that we had tackled back in 2018. So for us, it was quite refreshing, and it validated all the work that we had done. So we're pretty confident we're on the right track, but you have to be vigilant at the same time. When it comes to alignment, not fragmentation, I think you're seeing more and more of that globally, and I think everyone's going to use the IOSCO principles and guidance to create that alignment, like we did with banking and other securities regulations over the last 30, 40 years in particular. So I think alignment is well on its way.
Yusuf, what areas do you think have the most promise here? Which sectors for adoption of blockchain and digital assets as you see them? So traditional assets being put on chain.
Yeah, so for us, again, taking into consideration some of the risk elements and some of the misconceptions when it comes to digital assets. Obviously, when you mention digital assets, everybody starts thinking about crypto, including the regulators. I mean, I'm not just saying, not just the financial regulation, I'm talking about even the real estate registry, the Ministry of Justice, all the other regulators onshore. So they tend to get, you know, a bit freaked out when you talk about digital assets. So what we've done slightly differently to contain that element and make sure we do an experiment through a controlled environment is that we have chosen to use security tokens. And what I mean by security tokens is that you can tokenize private shares within our own registry and then set up SPVs or holding companies that get tokenized, and then you can dump any type of assets you want in that holding company or SPV. The first asset class that we would like to address is real estate. There's a lot of you have been around Doha in the past 2 days. There's a lot of real estate oversupply in the market, but it also solves a significant problem where there's not enough access into this asset class. If you look at a lot of the towers in West Bay or in Lusail or in any other area in Qatar, a lot of the towers are owned by 1 or 2 or maximum 3 landlords. And you know, these are significant ticket sizes. You're talking about a minimum of $500 million upwards. So, you know, tokenizing a tower or 2, I think would do great good for the economy and, you know, a lot more access and liquidity to the real estate market. But that's one asset class. I'd like to see as well, you know, Islamic financial products securitized through our corporate registration, bond issuances securitized, perhaps energy infrastructure in the near future. But what I'm saying is, you know, through our laboratory, I would say, which is our corporate registration, we can experiment without, you know, spreading the risk all over the rest of the economy. It'll be a contained environment. If anything goes wrong, then that would be contained within the Qatar Financial Center environment and the risk would be managed efficiently. So, you know, a lot of assets, I think, but we're going to start with real estate, and then we're going to start with financial products as well.
Do you see this as a way to attract foreign investment? You mentioned especially real estate, potentially.
Well, foreign direct investment is one of our objectives. I think what we'd want to see is some local investments in these asset classes to start with, but I think it will definitely give access to a bigger pool of foreign investors tapping into our economy, and then hopefully you'd have some cross-border transactions as well. On harmonization, I think that's a great idea. If we can, I think, you know, if there was any harmonization to happen within the digital asset space, I think the best bet is that it would happen between financial centers because we're a lot more efficient and swift in terms of amending regulations. I mean, it takes us less than 3 months to set up a financial services regulation and then get public consultation on it and then enact it. So we're pretty swift, and I think the same applies in DIFC and ADGM. So I think between those 3 financial centers, if we can come to a common arrangement where, you know, digital assets and certain financial services products can passport into each other, I think that could definitely be achieved rather than a larger passporting mechanism for the entire GCC, which could happen, but I think we're still far away from that.
So Ola, looking at sort of the outlook now, we talked about demand, but is there any specific area that you see having more demand? Is it coming, you're more focused on consumers, but are you seeing more activity from institutions as we're seeing elsewhere in the world?
Definitely. So from our standpoint, obviously now we're looking at growing more into, I would say, the institutional base. And a lot of that, actually, what we find in the region is mostly family offices that are getting exposure into crypto. Funds as well, but I think they're taking, you know, very kind of incremental steps toward that. Largely, I would say in this space, there's 3 trends that we're looking at very closely, and I think will be very exciting over the next 3 to 5 years. I think, not to repeat the point, but tokenization is a very important and I think will be significant market opportunity. Today, in terms of tokenization as assets, the market is close to 22 billion, apart from stablecoins. So I'm kind of removing stablecoins from that category. And a lot of that is across the DeFi space, tokenization of money market funds, and essentially where you get better returns or better yield as you invest in the token versus into the fund directly. So I think there's a lot of that innovation happening in the tokenization space, but obviously the opportunity is much larger. And as you mentioned, by 2030, actually the market is expected to grow in trillions of dollars. And that's where you see tokenization of hard assets, real estate, equities, et cetera. So definitely a very important vertical within crypto and high growth. I think second is stable coins and unlocking more growth through real-time cross-border payments. And there's been a lot of that activity as well, I would say, in the UAE market with opening up of the regulatory, kind of friendliness or frameworks. So stablecoins, I think, is a very interesting and high growth area, unlocking also, I would say, more trade growth. And overall, from a consumer level, B2B, and from bank to bank as well, in terms of, in some sense, providing a better cross-border payment network versus SWIFT and some of the other existing cross-border payment networks. And then I think third is institutional adoption. So we're definitely seeing the ETF market growing significantly. Interestingly, actually, as a sovereign wealth fund, Mubadala has grown its exposure in BlackRock's Bitcoin ETF up to 400 million or above 400 million in terms of exposure and holdings. And I think we'll see more and more warming up in terms of institutional adoption across the region, but also internationally. And lastly, I would say it's quite interesting to see the US building their own Bitcoin reserve by way of actually allocating some of the seized assets into that. And it'll be interesting to see how other countries would also respond to that. So institutional adoption overall has been growing, which is quite interesting.
So do you see also, Manuel, from your vantage point, more larger financial firms getting interested in operating in this space, coming to you and saying, hey, can we do something in this area?
Yes, is the short answer. In particular, in the last 2 years, we've noticed exponential growth in institutional interest in the framework and in different ways of approaching it, not just in terms of, say, custody, for example. We're looking at it from exchange operations, derivative-based products. So it's a range. But definitely the institutional-grade investors, I think, have changed the tide of the crypto market, but not just the crypto market, the digital asset market more broadly. BlackRock and its CEO came out, last year and espoused the virtues of an ETF, for example, but also other areas of growth in that area. So I think what we're seeing globally is the market maturing and developing. And that's important because having the institutional grade investors in the market with that maturity and understanding of financial services regulation brings the adults in the room to a large degree and accelerates the whole process of evolution of this industry. So we think it's clearly an asset class that's going to stay, and it's one that's growing. It's growing rapidly, and we as a regulatory agency at the FSRA, we want to make sure we can regulate it properly.
I think we've run out of time. Thank you so much.
Thank you.
Well, we have come to the end of today's sessions. I would like to thank our official partners, Qatar Ministry of Commerce and Industry, Qatar Media City, our cultural sponsor, Qatar Museums, our innovation sponsor, Qatar Research Development and Innovation Council, our premier sponsors, Qatar Investment Authority, Qatar National Bank, our knowledge sponsor, McKinsey & Company, Our participating sponsors, IDA, HSBC, Investment Promotion Agency Qatar, Qatar Financial Center, Qatar Free Zones Authority, Qatar University, our airline sponsor, Qatar Airways, our connectivity sponsor, Ooredoo, and our tourism sponsor, Visit Qatar. Now, we also invite you to the Bloomberg New Voices launch event for the Qatar Economic Forum. That is going to begin at 4:45 p.m., so in about half an hour's time in breakout room 1. You'll learn more about that program that sponsors media training for senior women in finance and other underrepresented experts from around the world. I myself will be interviewing Carmen Haddad. She is the vice chair of Citi Private Bank, and I really hope to see you there. We'll be starting back up tomorrow morning with our breakouts at 8:45 a.m. Thank you very much for joining us today, and we encourage you to spend your evening tonight exploring Doha. I'll see you tomorrow.